9 a.m. here in New York City. I'm a guide to help investors make smarter decisions for their portfolios. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a huge show for you today. The market looking to regain its footing, rebounding from its worst day in months as investors reset rate cut expectations. Futures are pointing to gains at the open right now.
And big tech is back front and center once again. Apple, Amazon, Meta all set to report after the bell. The results, well, they could determine the market's direction, at least in the short term. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Jared Blickery, and Dan Howley have more.
Hey, Shauna, the Federal Reserve holding its benchmark interest rate steady on Wednesday for the fourth meeting in a row and keeping that rate at a 23-year high. Fed Chair Jerome Powell signaling March might be too early for the central bank's first rate cut.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that.
Fed officials signaling the central bank will lower interest rates once they see further progress on inflation returning to its 2% target.
And chip sector recovery in question as investors' lofty expectations for AI keeps pressure on stocks. Qualcomm, the latest in the industry to report first quarter earnings. The stock seeing some pressure this morning despite beating street expectations on earnings and revenue. Results were encouraging to investors as the company's smartphone recovery and automotive growth boosted sales for the quarter.
Ooh, and big tech is top of mind for investors this morning. Apple, Amazon, and Meta are set to report earnings after the bell today. The pressure is on for the trio to blow past analyst expectations and avoid the same fate we've seen with Microsoft and Alphabet's mixed reports. Investors are especially eager to get a better read on the AI story.
The Federal Reserve on Wednesday holding rates steady for the fourth meeting in a row, but Chair Powell says a rate cut in March, which around half of traders had been pricing in, is unlikely. Investors now looking to May or June for the first cut. So how could that higher for longer stance from the Fed impact stocks in the year ahead? Yahoo Finance's Josh Schaefer is here with the details. Hey, Josh.
Yeah, Brad. So when you take a look at the market action yesterday, we obviously saw a risk-off sentiment pretty much market-wide, right? And we saw moves specifically in something like IWM or the Russell 2000 small caps, which have been a popular trade in the March cut euphoria that we had over the last 2 weeks. So investors cutting back bets in the short term. But I think in the long term, one of the key things to focus on here is not necessarily what Powell said about rate cuts, but what he said about the economy. He said, we feel like inflation is coming down, growth has been strong, the labor market is strong, and perhaps most importantly, he said those latter two things, that growth is strong and the labor market is strong, isn't as much of a risk to inflation anymore. So let's think about that from a macro perspective and what we're talking about here. The Federal Reserve Chair is saying the economy is doing pretty good, and we're not that worried about it anymore. So in essence, economic good news can be good news again. And when the economy is doing well, that means companies are doing well. So in the long run, it's probably good for earnings, I think, is sort of what I'm getting at here.
Josh, let's play devil's advocate, right? Because there is certainly a lot of reason to be optimistic, right? The economy holding up much better than expected. We haven't seen the job losses that maybe the Fed had braced much of Wall Street for. But is there some downside risk just in terms of the fact that if we do see a further delay in rate cuts, what that could mean then for investors?
Yeah, that's the key question here now, right? Is, okay, we've been doing well. Can we sustain, right? I think a lot of people feel like we're in a good place. When you talk to equity strategists, they've said, the difference between March and May doesn't matter. Ben Snyder over at Goldman Sachs, who I talked to recently about their call on small caps to go up 15% this year, he said, March, May, June, I don't really know how much of a difference it makes. When it makes a difference, Shauna, is sort of the point you're getting at, and this is what former Fed economist Claudia Sahm was worried about when we spoke with her on air the other day, is we have rates at a restrictive level. We are keeping rates at a restrictive level. At what point are we almost more or less gambling with the labor market and waiting for something to break? Because if something does break, then yes, this overall, the economy is doing well thing that's good for stocks, that falls apart if the rates start to take or start to take hold. Sorry.
Yeah, exactly. And that's the big question that we've been talking about, right? Just in terms of walking that fine line. They need to be careful not to cut rates too soon. But then on the flip side, like you were just talking about, they don't want to be too restrictive for too long. And then, of course, we could potentially, hopefully not, see something break here in the economy. All right, Josh, great stuff. Thank you. Let's talk a little bit more about this because Fed Chair Jerome Powell pouring cold water on investors' hopes of a March rate cut. And it's showing up in the numbers this morning, at least when it comes to expectations. So only 37% of traders are pricing in that cut for March. Makes a lot of sense because that's down from 53% yesterday. Now, this outlook from the Fed is not a huge surprise. If you've been listening on our show, the strategists that we've been talking to, here's what they have had to say about the potential timing of a rate cut.
I have a hard time seeing them going in March, which I know some other folks are out there suggesting will be the case. I suspect it could be one or two meetings following that.
I think the mix of what we saw in the data, if anything, reinforced that view that maybe early March is a little too aggressive.
It won't be in March, in our opinion. It'll be in the second quarter, possibly at the June FOMC meeting.
They'll probably be on the cautious side and just wait another few more weeks, and probably the first rate cut will be in May. But
all right, so let's talk about that timing of the first rate cut, when it will be and what the pace of the cuts could look like. We want to bring in Michael Puglisi. He's the senior economist with Wells Fargo. Michael, it's great to talk to you here. So we heard from Jay Powell yesterday basically saying do not expect, he did say, not basically, he said it, that do not expect a rate cut coming in March. What do you think the timing looks like for that first rate cut and then beyond the pace of the cuts before year end?
Yeah, well, thanks for having me, Shauna. And I think that's exactly right. So, I mean, going into the meeting that we had yesterday, our base case was the first rate cut would happen in May. That'd be 25 basis points, and we'd get another 100 basis points through the end of the year. So 125 cumulatively. And what I heard yesterday, I think really just reinforced that, which is, yes, there's been a lot of progress on the inflation side of things. Yes, the economy's remained resilient, but it's not just about getting back to 2% on inflation, whatever indicator you're looking at, but it's about sustaining it, right? And I think that was really the message we heard from Powell, which is we're on the trajectory to 2%, but we want to know we can sustain it, and we want to have that confidence. And so, to me, yesterday's meeting really didn't change anything in our base case outlook. I do think by the time we get to May, though, they'll have gotten a few more PCE deflator prints, a few more CPI prints. And if those come in as expected, I think you'll start to hear the tone shift towards, okay, we finally got that confidence that we're on the right path.
Yeah, certainly. I mean, we kind of got a sense of that from even the first few minutes of the presser, even before they got the Q&A, saying that they believe the policy rate is at its peak for this tightening cycle. And the economy, if it evolves broadly as expected, it's going to be appropriate to begin dialing back policy restraint at some point this year. So you're saying maybe by May, but then what does that do for us in terms of the rate or the pacing of some of those cuts as well going forward in the future? And where would the Fed make sure that maybe they're not cutting too quickly in that instance as well?
Yeah, and the way I think about this is on the way down, I think the cuts will start a little more quickly and then slow down. Similar on the way up, right? When the Fed was at zero and inflation was super high, they had to play catch up. In those initial hikes, right, they went 75s there back to back, and then they started slowing the pace down, 75, 50, 25 every other. And it wouldn't surprise me if the Fed went relatively quickly in those first few cuts. So we've got 4 straight 25 basis point cuts starting at the May meeting. And that carries you through to September. And I think once you get to the fall, they'll probably start to slow down some, as they don't know exactly where the neutral rate is. Maybe it's 250, maybe it's 350, maybe it's somewhere in between. But as they get closer and closer to that upper band of where neutral is on policy, I expect them to proceed more cautiously. Where I think there's more consensus right now is, right, 550, 5.25 there on Fed funds, that's restrictive. And they're there right now to bring inflation down. And I think once they knock that first 100 to 150 basis points off, past that, the cuts are going to be a lot more slow and gradual.
And Michael, it's interesting because this, of course, is an election year. Nick Timmeros over at the Journal had an interesting piece out this morning just talking about the Fed policy heading into that critical 2024 election that we have in just a few months. Talk to us just about your assessment of the impact. Do you think it will at all impact the Fed's decision, the fact that it is a lead up here to an election?
Yeah, I really don't think it will. I think the Fed is really focused on its dual mandate, and the dual mandate, right, being one, they want to protect the strong labor market they have. There have been a lot of lessons over the past 10 or 20 years that once you have a weakening in the labor market, it can be hard to stop and really hard to get back. And then, of course, they're focused on the fight they've had for the past few years, and that's taken a lot of sort of twists and turns. The pandemic hit, cut to zero, QE, all the steps they took, very rapidly ratcheting up, more than 500 basis points of tightening, QT. And I think at this point, this really critical inflection point as they're trying to, walk that fine line, as I think you said a couple minutes ago, Sean, and that to me is sort of the primary focus for them. And it's not to say they're not thinking about the election, right? What's going to happen on the other side of it with the debt ceiling and the 2017 tax cuts and tariffs and all these different factors. But I think the primary thing that's going to drive the bus, that's going to drive market pricing this year is what do those labor market readings look like and what do the inflation data tell us?
Michael Puglisi, thanks so much for taking the time here with us today. Wells Fargo senior economist here. Gave you a nice little promotion there, but you'll have to discuss that with your team. Appreciate it.
Thanks for having me.
Absolutely. Qualcomm paring back gains in pre-market trading after initially rising on a strong first quarter report. The chip maker pointing to a modest recovery in the smartphone market, seeing revenue from handsets rise 16% year over year, compared with a 27% decline in the previous quarter. We've got John Vinh, who is the KeyBank Capital Markets Equity Research Analyst here. John, always a pleasure to get some of your insights. So if we kind of look at Qualcomm and draw a through line of some of the other smartphone adjacent or even broader semiconductor space companies here, what is the kind of net takeaway as we're still waiting for some of those earnings to still come forward over the rest of this earnings season too?
Yeah, I think a couple takeaways. One, on the smartphone side, that the restocking cycle that started a couple quarter ago is sustaining. They beat numbers in the December quarter, guided the Android business flat, said Apple would be down seasonally. So one, we're still seeing strength and momentum on the Android side. That momentum is continuing to the March quarter. And, obviously there's a lot of concerns on the Apple side, but right now, none of the handset suppliers are seeing it. They're all guiding for kind of a seasonal decline in the March quarter, which is typically what you typically see on the iPhone side. And on the automotive front, automotive was up over 30% a year-over-year basis. It is expected to be down seasonal, but they're really not seeing any sort of weakness within the automotive market at this point in time.
John, talk to us just about those high inventory levels, because that seemed to be one of the pain points here, at least in terms of what the street was looking at from these results. Is that a Qualcomm specific issue?
To some extent, yes. I mean, their customers had built inventories going into the back half of the year. If you think about kind of the inventory cycles, their customers were destocking through the first half of 2023. They got back to normalized levels. What you then saw was Huawei coming back into the market, and all of Huawei's competitors started to kind of restock inventory. They viewed that Huawei coming back into the market would recatalyze the market. So they all built inventories into pretty strong holiday selling periods in the back half of the year. In China, you had Golden Week, which is the first week of October. You also had Singles Day in November, which is the largest online retail holiday. So they built inventory going into that period. You also did see sell-through obviously sustain itself on a positive basis over the last 4 months. But I think it is a little bit of a Qualcomm specific issues, but we think it's manageable at this point.
As we think about the handset business and the handset revenues that we saw come in at $6.7 billion higher than some of those previous expectations they mentioned, and primarily due to demand driven by Android flagship launches, we're going to see a wave of different artificial intelligence that goes into some of the smartphones that people, sleep next to and have in their hands all the time. How much of that is direct pass-through over time in that cycle to Qualcomm from your perspective?
They definitely stand to be a pretty meaningful beneficiary of that. Obviously, extremely early days. I don't think any of us can point to a compelling killer app on the generative AI side, but certainly they're already starting to embed that capabilities into their latest Snapdragon processors. Whether or not their customers build a quote-unquote AI handset or not, they're definitely going to see a kind of an ASP uplift to that at the very least. And from our perspective, we definitely believe that they're going to see some optionality related to that once AI handsets start to take off.
All right, John Vin, always great to get your insight here. Thanks for joining us this morning. KeyBank Capital Markets Equity Research Analyst. And stay tuned to Yahoo Finance. Our very own Julie Hyman is going to be speaking with Qualcomm's Chief Financial Officer and Chief Operating Officer. That interview, 10:15 a.m. Eastern Time. So keep it right here on Yahoo Finance. Well, it has been a tough start to earnings season, at least for mega tech. But can results tonight from Meta, Amazon, and Apple after the bell pull the sector back into its magnificent status? Yahoo Finance's Dan Halley joining us now with more. Dan, you've I guess, drilled it all down to one important thing that we should be focusing on from all these reports. Let's start with Amazon. What should investors be focused on after the bell tonight?
Yeah, for Amazon, it's going to be AWS. This has basically been their big money maker for some time now. They're diving in headfirst when it comes to AI. They've been made investments in Anthropic, that $4 billion that they made in the fall. They've also been putting out their own chips. They're on their, I believe, second generation of chips for AWS and AI training and inferencing. And we were hoping to learn more about where that kind of AI work is happening. Is it in inferencing? Is it in training? How many people are signing up for AI usage? What kind of usage are they seeing? How much is that costing Amazon to build out? So those are some of the questions that we're going to want to see answered. After that comes Meta.
Yeah.
And Meta's big deal here is going to be obviously ad sales, right? We saw Google suffer there with their report. That's why we saw them down, I think it was as much as 6% yesterday when I was watching it. Their overall ad sales were off expectations. And so that's what we're expecting to get, or what we want to get out of Meta, is exactly what the ad sales are. And then, maybe a little something on Reality Labs. If they're still just hemorrhaging money, I tell you what, I can do something with a couple of $1 billion. Just throw it my way, and it's better than burning it. And then Apple, we want to know, obviously, the big question, iPhone sales. It's been a big, big deal. A lot of analysts have been questioning what that's going to look like for them with the iPhone 15. China is the question that's on everybody's mind. How are China sales? What do those look like? What does that mean for Apple moving forward? And hopefully we get something from Tim Cook as far as the early pickup pre-orders for something like the Vision Pro.
It was anticipated, as you're laying expertly out all of the expectations going into and the top metrics to watch. It was expected that Amazon is going to be the bellwether of the rest of this earnings season here. What is the tone that you expect them to strike, even on the call after the results drop, to signal what the strength of the business is right now, both in their business-to-business side and the business-to-consumer side, which perhaps even gives us a little bit more of an economic read as well?
Well, I guess for the business, for the consumer side, I think one of the bigger deals was the addition of ads in Prime Video, right? So that's obviously going to be something that they're going to discuss. I think the addition of, it's been bad so far, but generative AI to the consumer reviews, woof. I've seen them so far. It just basically takes the consumer reviews and then gives you like a little snapshot. Not great. Maybe they'll give us something on that. Maybe they'll update it. I don't know. But overall, I think it's going to come down to the business to business and what that says for Amazon. What kind of uptake are they seeing? How is cloud growth going, right? Their growth wasn't as impressive as Microsoft's has been, just because of the, it's just large numbers, right? They had hit a certain point. It was like, you can't grow as fast. That's why Google is, growing so fast. They're not nearly as big. And, we're talking about AI, and it's important to point out that AI is part of the cloud, right? You can't get AI without the cloud. And so when companies are inferencing this, which is using AI, they're still accessing cloud capabilities, and that's still good for the likes of Amazon, Microsoft, and Google. So, as more people want to lean into AI, it just adds more revenue to the cloud side. And I think that's something that we're going to want to watch out for.
Yeah, certainly. Well, we've seen many of these stocks really priced to perfection, especially Amazon, especially Meta in some cases here heading into these earnings. So any sort of disappointment could really put weigh on the stock here, at least in the coming days. All right, Dan, thanks. Well, coming up next, shares of Merck and Canada Goose are on the move in pre-market trading, both out with quarterly results. We got those numbers for you when we come back.
Let's take a look at some trending tickers here as we're starting things off. Merck, you're seeing shares move higher by about 2% after seeing revenue rise 6% year over year, getting a boost from demand for its cancer drug, which saw revenue jump 21% from a year ago. Again, pre-market here, shares are moving higher in reaction to this. One of the things that really kind of jumped out with regard to Merck is the fact that for the demand that they're continuing to see come through. And we have to note that the through line here within this industry has been the oncology businesses across the board, where research and development and demand continues to move higher here. And they said that the fourth quarter and full year sales actually also reflect sustained growth across that oncology business, but also vaccines too.
Yeah, vaccines certainly a driver here going forward, looking to diversify their pipeline. We know Merck is going to lose the patent on Keytruda here going forward in 2028. So the big focus here for investors over the last year, and of course looking ahead to the next couple of years, is going to be on some of those future investments, future acquisitions, in order to further diversify their pipeline. But when it comes to these results, it's a pretty good quarter here for Merck. JP Morgan calling it a solid update here for the company. The fact that they beat expectations on earnings and revenue in terms of guidance here going forward to 2024. Certainly a solid move to the upsides here. And we're seeing that reflected in the share price this morning with the stock up just about 2%. All right, let's take a look at Canada Goose flying high after seeing revenue climb 6% and direct-to-consumer sales jumping 14% from a year ago. Now, the luxury retailer also posting upbeat guidance for the full year. They saw record customer traffic over the Black Friday shopping weekend. So certainly strong holiday report here from the company. They did see an uptick in terms of traffic. They're also seeing the recovery in the Asia Pacific region, which is critical here for Canada Goose, and also in the Americas, where we know they have been boosting the number of stores. So that initiative really paying off, at least for now. But you got to keep a close eye on this name, because when you talk about any pressure that we could see on the consumer, a name like Canada Goose could feel the results of that.
I was in Montreal to start the year, and I got to go to my first Canada Goose store in Canada. They had a freeze chamber in there. It was fancier. They had a whole frozen chamber that you could go in. I posted the video to my Twitter, or X.
How effective was the jacket?
Very effective. And I'm glad to know that it was, because it was the one that I owned.
Good marketing technique.
Oh my goodness, it was good. But you point out Asia Pacific, extremely important here, because that actually offset the declines that we had seen. Revenue was down in EMEA and North America as well. In Europe, Middle East, Africa, it was down 26%, 14% lower in North America year over year. Decline in e-commerce and wholesale revenue they mentioned, but 62% higher in Asia Pacific. So it's about the lean into Asia Pacific that we could continue to see from this company, and across a different range of product types as well.
They're still really expensive, though.
Well, actually, yes. So the other thing that I was considering too is they have a new trade-in program that I think started this year too. And so with that, I've been kind of poking around on that part of the website as well.
And makes it cheaper.
Yeah,
you can trade in the one that you have for a new one. Is that how it
right?
works?
You can trade in yours. They'll kind of evaluate it and then give you a discount or a just a voucher to use towards a new one.
I don't know. If I'm paying $1,000 for a jacket, I'm holding on to that thing for life.
Oh yeah,
It better.
100%.
Better hold up for life.
It's getting passed down to everybody in the family.
All right, guys, keep right here on Yahoo Finance. It's just about 5 minutes until the opening bell on Wall Street. We've got more on that when we come back. All right, time for our stock to watch. Shell keeping up the pace of its buybacks, announcing another $3.5 billion share buyback here, also raising its dividend. And this, of course, coming on the day that the company reports quarterly results. We want to head to Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with the movement to the upside that we're seeing here, Maddie.
Yeah, Shell reporting $28 billion of revenue, but that beat was not enough. Even though it was a beat on estimates, it was a 30% drop from their profits from the prior year, which was over $39 billion. So what's interesting to me about this stock is that it continues to follow this trend that we've been seeing, where when you've had these incredible growth years, think about an NVIDIA, think about Apple a couple of years ago, it's hard to continue that growth moving forward. But having said that, the CEO said, look, we still had a good year and we're expecting to have more growth ahead, but we know we got to do more to keep that growth up. A positive indication here, exactly like you mentioned, Shauna, increasing their share buyback program to the tune of $3.5 billion. They had enough cash on hand to increase dividends by about 4%. So if you're looking for a little bit of diversity in your portfolio, looking to get in on a name that's going to have a dividend play for you, that could be a boon in your mix of stocks. Also, if you're looking for a play that could be a little bit inflation-proof, if you're worried about inflation bumping back up, sometimes getting in on energy is a good way to diversify your portfolio around that potential concern. Also, Shell really upping the bar for Chevron and Exxon. Those earnings are going to be coming out tomorrow. So interesting to see whether or not those names are able to stick to the positive picture that Shell was able to paint in their earnings. That stock is up a little over 2% in the futures this morning.
All right, Maddie, stick around here because we're going to head back to you in just a minute, but we are about 30 seconds here until the opening bell. You can see a lot of the excitement playing out, or hear a lot of the excitement playing out on the floor of the New York Stock Exchange today. Again, we're seeing a bit of a rebound here, Brad, ahead of the open. Hopefully it carries through on the heels of what was a terrible day for stocks yesterday on that Fed decision.
Yeah, it was not good. In fact, worst of the year, as our own Jared Blickery told us earlier before the bell. Yes, that's okay. Press the button, ring the bell. Amber Sports actually ringing the opening bell here this morning. That's the parent company of some of your favorite kind of ski equipment.
Salomon.
And yeah, exactly. Salomon. They've got Wilson in there as well. So good to see them up there on the podium at the New York Stock Exchange. And then in Midtown Manhattan, you've also got ARC. I think there was a Q on there. Anyway, taking a look at the major averages right now. We opened mixed. The Dow and the S&P 500, they're higher. And it looks like the Nasdaq calibrated higher as well, as we were just waiting for that update. But higher across the board.
Yeah, rebounding from yesterday's steep sell-off. All right, well, let's get back to Madison Mills standing by on the floor of the New York Stock Exchange with our guest, Jay Woods, of Freedom Capital Markets Chief Global Strategist. Maddie.
Shauna, we are so lucky to be able to be here with Jay this morning. He is a king here on the New York Stock Exchange. When I'm talking about my sources every day, I'm talking about this guy over here. Jay, I want to get a sense of what the vibe was yesterday. We talked around 1:30. Everything changed at 2. What did your desk have to say about Jay's comments yesterday?
Yeah, I mean, the vibe was a little shocked that he said no cut in March. Usually he gives himself some wiggle room, and he kind of painted himself in a corner there. But everything else was pretty much true to form. I didn't know this stat that Bespoke was nice enough to tweet out yesterday, but we were down 1.6% in the S&P 500. During Jay Powell's tenure, we're down an average of 1.5% after Fed Day, regardless of what the decision is. So, you know, given the run we've had, we're really more focused on earnings, but Powell basically has left the door open for us to focus on data, and that's what he always does. We're data dependent. We're watching jobless numbers. Jobless claims ticked up a little bit, and now unemployment number tomorrow, they're expecting to rise from 3.7 to 3.8%, anything above 3.8%, and that may put this, maybe March can come back on the table, but we're going one data point at a time. The only shocking thing was he was definitive no cut, and that was surprising.
Definitive no cut, and then we had all these analyst notes I was reading last night and laughing because it was giving me the vibe of me and my friends in a group chat, like looking for reasons that a guy likes you when he's not that into you. Like, he said no March, and why are we looking for evidence that there's still going to be a cut in March? What did you make of that hope for still there to be some sort of cut to come?
Well, your group chats are a little different than mine. We think May is definitely going to happen. We've been anticipating a cut. the Fed tends to do things a little too late, whether it's hiking or lowering, and maybe this was the time, or March will be the time to go a quarter of a point. We thought that last quarter of a point raise wasn't really necessary, but the narrative higher for longer is here, and we'll see what your group chat says, what my group chat says as we get closer to the March meeting.
Well, now we're all focused on big tech earnings. What is your advice to our audience of retail investors about how they should be parsing the names reporting today?
Okay, well, we had Microsoft and we had Google on Tuesday, two stocks that reported earnings they beat and they pulled back. This shouldn't be unexpected. We have two stocks tomorrow in Amazon, well, actually three stocks, Amazon, Apple, and Meta. Meta and Apple are stocks that could pull back. Apple's the one that has me concerned. The stock is, of the 5 stocks that will report, the only one that made a lower high. Everything else was making 52-week highs or all-time highs. So the price action has me concerned. If you're watching Apple, you're trading Apple, watch that 200-day moving average around 182. That, to me, will be the tell. And then, of course, we want to hear their AI story. The typical Apple things. Amazon, of the 3 that report, still has a ways to go before all-time highs. I think that could be the one that could surprise people if we see an upside move. And then, AI story people want to hear. So those are the stocks that are going to move the market. The Fed is behind us. Market's rallying a little bit today. That's nice. Pullbacks, given the run we've seen, it's not out of the ordinary. Let's put things in perspective, and we'll build from it. But the earnings will be the story that we're all talking about the rest of today, tomorrow, into next week.
All right, so sloughing off the Fed meeting, focusing on those big tech earnings. Jay, thank you so much. Really appreciate your insights as always. Shauna and Brad, back to you guys in the studio.
And Maddie, I gotta say, we love the insight on the group chats. I'm right there with you, by the way. And my takeaway from the whole conversation, your group chat's a heck of a lot more exciting than sounds like Jay's are. All right, Maddie, thanks so much for bringing us the latest there from the floor. Well, it is a critical day here for the market. We want to check out some of the action that we are seeing at the open following that Fed decision or Fed rhetoric that we got there from Jay Powell last night, and then also what we could hear from some of those tech giants today. Jared.
That's right, Shauna. My group chats, for the record, are always about bonds. So this is much more interesting.
That's even more boring.
Well, we got an updraft today. That's after a big downdraft yesterday. And you guys are absolutely right. It was the worst day of the year for stocks, but also the best day of the year for bonds, which means the yields were dropping. And let's take a look inside the market at the sector action. Then we got some big picture stuff for you. And materials, XLB, you don't usually see that leading, but it is today, up 1.5%, followed by communication services. That's Alphabet and Meta and others. And then consumer discretionary, which is Tesla and Amazon. To the downside, we got utilities, healthcare, staples, and real estate, all 4 of those defensive sectors. So actually a pretty bullish setup, even though you see some red on your screen. Well, I want to go now to the S&P 500. Yesterday was a pretty interesting day in the market. And let me just show you, we got this zigzag price action here. And it's funny, Jay Woods was just talking and quoting Bespoke, and here's something that they were referencing yesterday. Today was, and this is yesterday, was a pretty bread and butter Powell Fed day, huh? And in blue, we have what usually happens on Fed day with Powell, and then in red is what actually happened. Pretty close there. So why do I say this? It has predictive power, so it tells us that today could potentially be a down day as well. But I want to focus on the long term here, and this comes by Urban Campbell. The S&P 500 up 3 months in a row, greater than 15%. That's what just happened. Since 1980, there have been 9 other instances. None was a top. All mostly were the initiation of an uptrend, but a few 3 to 7% corrections in the interim. So we might get a little bit of a slowdown here in the interim, but bullish over the long term. I just want to show one more chart. This is the year, what usually happens with stocks. February, you can see by all 3 of these metrics, tends to be down. So that's that interim that could be weak here, guys.
Jared Blickery, certainly do appreciate it. And since we're disclosing what our group chats are like, don't text me unless you want to know what long and variable lags feel like. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Oil edging higher to start the month of February as the market digests the Fed's path for inflation, or interest rates rather, and the latest OPEC meeting. Now, this coming after oil prices close out January with its first monthly gain since September. Here to dive into the energy trade, we've got Sam Dart, who is the Goldman Sachs head of global natural gas research. Sam, great to have you here with us this morning. First and foremost, as we come off of the month of January and kind of look back to what fluctuations we saw in the oil price market, what does that set up? What's the trend looking like going into February?
Yeah, so the geopolitical tensions, especially in the Red Sea region, have definitely played a role and have lent support to oil prices a few dollars a barrel in recent weeks, right? But the way we look at the market, we still see oil prices range bound between $70 and $90 a barrel. A big reason for that is at the end of the day, despite the tensions, we have not had serious supply disruptions. And in fact, we still have a lot of supply spare capacity in the system.
So Sam, what does that mean then for prices going forward? Because here we are with Brent right around $82. We have crude that has been moving to the upside. Are we near that top that we would potentially see, at least in the short term, given the fact that this disruption hasn't had a massive impact on the crude market?
Yeah, we think we are. We expect to see oil prices peaking this year in the low to mid 80s. So we're pretty close to those levels already. We don't see a lot of fluctuations unless we had a pretty significant supply disruption in the system.
What would a significant supply disruption look like? Is that an OPEC decision? Is that more international uncertainty or conflict there that stems? What is perhaps that biggest headwind risk that then spurs the perhaps exogenous threat?
Right. So OPEC has been cutting supply now for many, many months. So the way that has played out, because inventories are not particularly tight, is actually it provided a cushion to the market, meaning if things go tight, you can have that cushion used with OPEC bringing back supply. Now, the big risk, to your point, is if there is some exogenous factor that can block it. So, for example, if we had a blockage of the Strait of Hormuz, which would indeed block a lot of Saudi supply of oil, that would be extremely problematic for the markets because it would impede OPEC from bringing back barrels to the market. Now, to be very clear, we think this is very, very low probability. This has never happened, and there is a reason for it. It would block, by the way, not just oil supplies, but a large share of LNG, liquefied natural gas supplies to the world as well.
Sam, another trade that got our attention is the price of lithium, the fact that it has been under tremendous pressure now for quite some time. A bit of good news here for some of those EV players that are struggling with demand. When it comes to that depressed price of lithium, do you expect it to stay at these levels, or what does the trend look like, do you think, for 2024?
Yeah, this is something we have been calling for a few months as well. It's interesting because we talk so much about green demand, and this is a strong pillar of our bullish commodity views, but especially on the copper side. When it comes to lithium, the issue is that supply is very abundant. So even though demand is there and it's still growing, you don't have tightness in the market. So we expect this softness to continue on the lithium side. Whereas on the copper side, what we see is the opposite. We see demand still growing, but the supply picture is actually getting tighter year after year.
You know, as we're thinking across some of the commodities, what is the hottest area that investors perhaps should be positioning their portfolio or adding some type of positioning in their portfolio where you're seeing a lot of volume or inflows?
Right. So I would say two things. From our side, where we see most upside is really copper and refined oil products. And the reason is on the copper side, as I said, supply is dwindling, so you have a tighter and tighter market. And on the refining side, you know, I just mentioned the spare capacity from OPEC for oil that does not exist among oil products. So the product market is very tight as well. So when we recommend the best opportunities, we really focus on those two, copper and oil products. Now, when we talk to investors, where we see the most interest has been on the copper side. I think that's the most consensus view at the moment, whereas on the refining side, we still get some pushback with investors expecting high product prices to fix the problem by inviting more refining capacity. We don't think that's likely, just because refining capacity takes really a long time to build. And especially these days when you have so much uncertainty regarding long-term oil demand, it's difficult to also get capital availability for that kind of investment.
Sam, let's talk about gold real quick before we let you go, because it is under a bit of pressure this morning, but not maybe as much as investors would have anticipated, given the fact that Fed Chair Jay Powell basically said that the Fed is not going to cut rates in March. When the Fed, or if the Fed eventually does decide, when it does decide to cut rates, how big of a catalyst do you think that's going to be for gold prices?
Yeah, it's definitely a powerful catalyst. And by the way, that's another commodity where we see a lot of investor confidence. It's one of the preferred commodities. We think that support is still there. And yes, as you pointed out, in large part because of declining rates going forward, but also supported by geopolitical risks. So there are a lot of good reasons to go into gold right now. We still expect it to go above 2,100 by year end.
All right, Sam Dart, always great to have you at Goldman Sachs. Thanks so much for taking the time to join us here this morning. Well, shares of Cardinal Health moving to the downside despite reporting stronger than expected quarterly results. We've got the company's CFO when we come back. Cardinal Health shares falling despite a stronger than expected quarterly report. The drug distributor and maker of medical products also raising its outlook for its pharmaceutical and specialty solutions divisions. You're looking at losses today of about 4%. Since the start of the year, though, the stock had been up about 8% heading into this report, now up about 3.5%. Over the last year, shares up nearly 40%. We want to bring in Aaron Alt. He's the Cardinal Health Chief Financial Officer. Aaron, it's great to have you here. So talk to us just about the trends that you're seeing within your business. Yes, you're able to offset some of the headwinds, some of the challenges that has been plaguing the healthcare and financial sector here heading into the new year. But what is the biggest challenge that you're identifying for 2024?
Really appreciate you having me today. The Cardinal team was delighted to report strong results this morning, really across the board, with revenue growth up 12%, profit growth up 20%, and EPS up 38%. And you're asking about the why, and it's because we're seeing strength across the business. As we look at our primary business, the pharma distribution business, the strength that we're seeing comes from a couple of things, starting with our generics program and the strength that we have with our customers supported by our Red Oak platform. We're also seeing strong prescription demand in our branded portfolio. And so as we look back and indeed as we look forward, our guidance, which we raised today significantly, is driven by the expectation that prescription strength will continue and we'll be able to service that strength through both the generics program and our branded partnerships with our key providers.
What type of contribution on the margin front do you expect that generics program to continue to add into the business? And where then are you able to kind of reinvest some of that capital?
Yeah, it's a great question. I would answer it this way. Within our business, we're a distributor, so it's a relatively low margin business. The generics part of our platform is the key contributor to our profitability. We are paid largely on a fee for service basis with our branded portfolio. We love innovation. We love the branded growth. It drives much of the revenue top line. But of course, we have the cycle of drugs out there. So as we look forward, we expect continued innovation in the branded side of the portfolio, and we also expect continued movement from branded goods into the generics portfolio. Now, that has generated a lot of cash, and one of the upsides for us today was the fact that we were able to call out that we have $4.6 billion on the balance sheet at the end of our quarter, driven by really strong cash trends in the first half of our year. And to your question around where we're investing, we're really investing in key areas across the portfolio. First, within specialty pharmaceuticals. Our primary business, the pharma distribution, is a combination of single-digit growing core pharma business, but also double-digit growing specialty pharmacy. And we are really doubling down and investing in specialty pharmacy, including in the recent acquisition of Specialty Networks, which we signed and announced yesterday. So we're excited about the future that will have on our portfolio. We're also investing against our overall network, additional distribution nodes within our medical business, within our pharma business, within our consumer health business as well. And so we at Cardinal are taking a long-term view of continuing to serve our business every day to give the customers what they need to make sure we're serving them and the patients are getting the drugs they need, while also investing for the long term. And that will mean about $500 million of CapEx over the course of our fiscal year 24.
Aaron, you mentioned that deal that you guys just announced yesterday, acquiring Specialty Networks, $1.2 billion. What stuck out to me about that deal is the use that company has using AI to analyze data. I'm curious how you see the integration of AI and how big of a driver that could potentially be for revenue for Cardinal Health in the long term.
We see lots of opportunity on the horizon, and that's why we're so excited about the Specialty Networks acquisition and indeed the leadership team that we're acquiring by virtue of acquiring Specialty Networks. You need look no further than the front pages every day to understand the impact that AI is having on life and business as well. And as Cardinal continues to advance against its strategic plan in our core pharma and specialty business, the fact that we're able to bring the Specialty Networks people into the family, that we can help them drive their business with our balance sheet, but more importantly, we can leverage the resources they have, invest in it further, and drive that AI benefit, that expertise benefit, the practice enhancement benefit across the broader ology portfolio. That's going to be a big win for us.
Aaron, I wonder how you're evaluating the GLP-1 market right now. JP Morgan Research, they forecasted that the market's going to exceed $100 billion by 2030. That has considerable kind of effects or ramifications when you think about some of the other flow-throughs as a result? In addition to weight loss, perhaps you're lowering the risk of heart disease. And so with all the study that's come forward, how does Cardinal Health kind of evaluate that market and kind of get ahead of where that means that you're going to have a different type of patient experience that you need to put forward?
Sure. Well, let me start by saying that we love innovation, and the GLP-1 is a great innovation in the industry that is supporting both our customers and their patients. And we actually move a significant amount of the GLP-1 product through our own distribution chain. Now, as we think about where that goes from a broader picture perspective, the current concerns are often raised, well, what will it mean for other parts of the medical industry? And right now we're taking a wait and see approach, right? There's been no noticeable impact on the business. And I think as we see how continued innovation in GLP-1s advance, how adoption advances as well, we'll bob and weave accordingly, because we are an essential part of the American and global healthcare ecosystem, and we're here to serve the manufacturers and the customers as they provide the most recent innovation to the patients.
Aaron, starting today, the Medicare drug price negotiations are starting on Capitol Hill. But when you take a step back, the wholesaler aspect of this in terms of drug pricing, how are you navigating that? Do you think changes need to be made in order to make prescriptions, to make drugs more affordable to people out there who need them?
Yeah, look, at the end of the day, Cardinal is motivated to ensure that the patients are getting the right drug at the right cost at the right time. And we're an essential part of the healthcare ecosystem. Our role is we're the middleman, right? We don't make the products, right? We don't administer the products, but we make sure that the patients have the products on time and in the right places. And so our role is to ensure that things are being done safely, that they're being done securely, and that they're being done as efficiently as possible. And in this industry, the business model evolves over time, and we are committed to, and indeed we've proven over time that we can evolve our business model to meet the needs of those patients and our ultimate manufacturer partners as well.
Aaron Alt, Cardinal Health CFO, joining us here on Yahoo Finance. Aaron, thanks so much for the time breaking down some of the results from the quarter.
Thank you for having us.
Absolutely. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Hey there. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks opening higher to kick off the month of February, rebounding from a very bad Wednesday after the Fed poured cold water on the market's March Fed rate cut hopes. Now investors await 3 more Mag 7 results after the closing bell today.
All right, taking a look at some of those individual names. First up, Deutsche Bank. Shares moving to the upside after announcing plans to slash 3,500 jobs. Now, the cuts are part of the bank's plan to reduce costs by $2.7 billion by 2025. Deutsche Bank also saying it will boost payouts to shareholders with $1.7 billion in buyback and dividends.
And Royal Caribbean, yeah. The stock is flat after notching its 7th consecutive quarterly earnings beat before the bell. Cruise operator also reporting a full-year outlook that would set a new company record.
All right, and Honeywell, the stock dropping after the company saw sales miss expectations in its fourth quarter. Also, a weak forecast for the current quarter due to lower demand in its building technologies business. One bright spot, though, for the company, its aviation division, where Boeing and Airbus are its customers. Now, organic sales rising 15%, though you're looking at the stock under pressure today, off just about 4.5%. Let's take a look at Peloton. Shares are plunging this morning after reporting second quarter results that disappointed the street. You're looking at a loss. Look at that, 18% below $5 a share. Now, the exercise equipment maker showing mixed results, beating on revenue, but it did report a slightly steeper than expected adjusted loss per share. Here with more reaction, we want to bring in Bernie McTernan. He is Needham & Company's managing director. Bernie, it's great to have you here. I think a lot of investors are scratching their head trying to figure out what exactly the future looks like for a name like Peloton. The company has failed to really turn around its business now for the last couple of years, ever since it's hit its high in the height of COVID. What do you think the future looks like for Peloton?
Yeah, well, it's challenging right now. And so in the holiday important period for Peloton, adjusted EBITDA coming in lighter than expected. So that's both for the December quarter and then the guidance for the March quarter. And really, the difficulty is that they spend it's LTV to CAC. They spend, this past quarter they spent $200 million on marketing, but net ads for their connected fitness subscriptions were only at 40,000. So it's really that equation is just not working. And so Barry on the call mentioned that they could make some significant structural changes to their marketing budget to drive operating leverage, which would certainly help. But right now, it's a company that still has, probably just under $3 billion of enterprise value at this point. And so getting back to EBITDA positive next year is really important, but to generate the, hundreds of millions of dollars to support that valuation is important.
Stock's down 72% over the past year, down another 16% here today. Bernie, you still got a hold on it. What would you need to hear to ultimately pivot that rating and say, hey, this is a sell at this point?
Yeah, look, the problem is it's a great product, just not a great stock at this point. I think most of the bad news is already factored in to me. So for me to get even more bearish, it would have to be that we would even be longer away from getting back to adjusted EBITDA, longer away to getting to free cash flow positive. And that's why I mentioned the important things that Barry calling out on the call, saying that there could be structural changes coming. And then sales and marketing matters, but ultimately it's revenue growth as well. And so they were calling out success that they've had with third-party retailers. So that's like a Dick's Sporting Goods or an Amazon, also with their rental program as well, too. So it's really balancing, revenue growth versus profitability. And then I think ultimately, what's difficult for the company right now, too, is balancing the short term versus the long term. And so getting back to revenue growth, if they're able to do it in this challenging market for connected fitness, would obviously be the most bullish thing for the company. But if you're managing costs more on a near-term basis, I'd be focusing more on things like cost cutting and price increases to really maximize those 3 million connected fitness members that you have. But again, that's probably not the best for the long-term opportunity.
Brittany, talking about the long term, the fact that, like you just said, Peloton, it's business, it has products that are attractive. Do you think it could be, is it a potential takeover target, something that we have been talking about now for 12 to 18 months?
I know. Well, I think some of the culprits that we were potential M&A candidates that we're talking about before that could take over Peloton, probably a bigger fish to fry now than connected fitness market, thinking about generative AI. So, Apple and Amazon always came to mind. I just think they're probably focused on larger opportunities now. And then also with Amazon, the iRobot acquisition getting shot down earlier. It's unclear what they would be able to buy or not. And then, so that's why I mentioned, short-term versus long-term. That short-term perspective is almost like a private equity angle. And so I think that's what you would have to be looking at in terms of, takeout candidates. I think that would probably make the most sense at this point.
What is the best pivot that connected fitness companies can and need to make right now? I mean, Peloton, even in this quarter, they were talking about just making sure that people could rent them at first and then transition them into sales. What is the overall categorical shift that needs to happen?
Yeah, well, I think it's that you dealt with a big pull forward from the pandemic, and that's what you're dealing with now. And Barry talking about what's going to drive growth in the future, and just like aging population, things that we talk about. But there's a lot of 35-year-olds now who might own a bike that would have been buyers at 45 years old, but it got pulled forward during the pandemic. So I think just going after new ways of product market fit. They were leaning in early on their free digital app. Now they're leaning in on paid digital apps. I mean, they're just doing a lot of different things to try to see what sticks, to be honest. And the other thing that Barry alluded to on the call is that there will be more on new products coming to market over the next year or two, and geographic expansion as well. So I think those are, continuing to see kind of what can drive growth here in terms of new market opportunities, for the business, because ultimately what they want to do is they want to leverage their content. They have best in class content. So how can you leverage that in different ways? The TikTok partnership, they were scant on details in terms of what they expect that benefit to be, but that's another example of leveraging content to hopefully engage their audience more on other platforms.
Yeah, sounds like it's not going to be in University of Michigan colors anymore, though, Bernie, based on what was in the release here. Bernie, appreciate the breakdown. Bernie McTiernan breaking down all things ticker symbol PTON. Peloton down 18% right now. Well, stocks are looking to recover today after a disappointing first round of big tech earnings failed to impress. But can results from Apple, Amazon, and, Meta shift the tide for investors? Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, joins us now. Victoria, great to have you here in studio with us. When you think about what we would need to see from these companies that are reporting later on today, what would be the overall tone, the tenor, or even the catalysts, perhaps, that the markets are able to latch onto?
I think it's going to be quite difficult, Brad, because as we've seen, they have had a huge run-up, and I think it's part of the problem we saw with both Alphabet and Microsoft. You've had such large gains. People have already priced in that perfection of having the monetization of AI, which is something people have been waiting on, and then we're getting information on CapEx spending going to be much higher than what a lot of people anticipated. Margins maybe not being as high as some people wanted. So there's going to be some difficulty, I think, in hitting some numbers that continue to make the stocks move higher. Obviously, Apple is probably the one that people are concerned about the most. It has been down versus the rest of that Magnificent Seven for a while, except for Tesla, and that one's been down too. But I think it'll be a little bit tricky for them to meet expectations.
So if they don't meet expectations and we do see some pressure on these big names, how should investors be viewing that? Is that a buying opportunity?
Well, we've seen the Nasdaq pull back pretty significantly this week because of the earnings that we had. We don't think you want to go all in. We've actually been trimming a lot of these Magnificent Seven names as they have been making highs, going in and trimming some of those positions. Right now, Microsoft is the only one we're actually above weight versus our benchmark. We're below weight on all the others. So if you don't have a neutral holding in there, could you go in on some of these and add? You could, but I think you need to be a little bit more diversified. Those names have been driving the market, and when you look at earnings, they're expected to be 80% year-over-year earnings growth in next quarter as well. That's going to be a really hard level to beat, so I would be cautious.
What's the bullish thesis? Why do you think Microsoft is the best pick, it sounds like, of the seven right now?
I think when you look at balance sheets and you look at expectations, you look at where they stand with AI compared to some of the others. Obviously, NVIDIA is run away with that, but Microsoft is so strong in that element, and being able to monetize that is going to be key. Their balance sheet is strong, their free cash flow is good. So I think from that perspective, we always want to look at balance sheets when we look at the companies we invest in. That's why Microsoft is probably one of our favorites.
And then when you think about the earnings bellwether that we've continued to hear time and time again, Amazon, I mean, both on the consumer side, but also on the big business-to-business purchasing side there, how can this company perhaps give the markets a jolt for the rest of, that can last the rest of the earnings season perhaps?
Amazon specifically? So Amazon, because they have so many different business elements, they're able to kind of pull from different areas that maybe some of the other companies can't. And we've seen them do that in the past. Obviously, AWS is going to be huge. We're going to see how that pulls in. Now, Azure had some issues, right, in those earnings. The non-AI component of Azure was lower than what people thought. So we might see that coming in from Amazon as well. But guys, you know we've had a strong consumer, so those will probably pull in from the retail side and really be able to give it a boost there. So I think Amazon will do okay, but they've also come out and talked about layoffs. Layoffs are huge right now. We're seeing about 13% of the S&P 1500 companies that have reported talk about layoffs or announce layoffs already. That's more than double what you typically see in a bull market. So we need to be cautious on that.
Talk to us a little bit more about that, just in terms of how investors should be thinking about it, because when you take a look at the labor data that we've gotten out leading up to the report that we're going to be getting tomorrow morning, labor market, yes, it's weakening, but it's remained resilient. Do you think that narrative or some of that trend is going to start to materially change then to the downside?
So I sat in this seat last year, end of last year, and we had a conversation about how we thought the market had really gotten ahead of itself in terms of what the Fed was going to do because we thought there was going to be some weakness in the labor market. You look at profit margins. We think that's where we're going to see some hits come in. And what are companies going to do when their profit margins get hit? They're going to start laying off. We're seeing announcements across the board. It's not just in one area, right? We see it in retail like Macy's or Wayfair, but you see it in Salesforce and SAP. We talked about Amazon, UPS. So I think as you start to see that labor market weaken more, it is a signal that we truly need to watch, along with credit spreads. Those are the two things we really think people need to be paying attention to. But that labor market, I think, is where you might start get the first hints of a larger pullback or a recession coming into the economy.
All right, Victoria, always great to have you here on set. Thanks so much for joining us here this morning. Keep right here on Yahoo Finance. Coming up, Qualcomm's first quarter results pointing to a recovery in the smartphone chip market. Our very own Julie Hyman takes a deep dive into the report with Qualcomm's CFO next.
City boys are up. Lululemon has finally added a men's shoe collection as part of its 2024 spring and summer footwear line here. You're taking a look at shares. Yeah, they're up by about 0.9% here. I took a look at these silhouettes. I mean, I think they've got some options here that can certainly go well with the existing men's wear on the apparel side. It's just a matter of the pricing, and that's going to be interesting here. Taking a look at the release here, expanding the footwear offerings, casual and performance styles. And we've got our own Julie Hyman here on the desk with us to help us break this down a little bit more. I mean, Julie, chiming into the chat for this momentous occasion. This is a historic milestone for the company.
Momentous for Brad.
Well, you know what? I'm looking at the website. Right now on the website, they still only have the men's slides that are available. They don't yet have the sneakers. You know, and I like to talk about the Lululemon shoes because when they first introduced the women's line, Brian Sazzi, wherever you are, did not think that they would be a hit, and yet they have been a good seller for the brand. So it makes sense, just like they have their men's wear line has been a big growth driver for them. It makes sense now that they're getting into the men's sneakers. The question, like as always, you know, who's going to be the customer for the men's Lululemon shoes? Is it going to be the athlete? Is it going to be the sneakerheads like Brad Smith? That's the question here. Are they fashionable enough to satisfy a Brad Smith?
They're fashionable. And I think the question is, I don't know how much people will really be using them in terms of the athlete side of it, if you're going to be using them to work out, but it's more the casual sneaker, right? And that trend has really taken off with men, with younger boys too, as well, in terms of that everyday wear going forward. It could be a huge hit for Lululemon. I got to say, I wasn't a huge fan, though, of the women's shoes. I got to go back and try it because a lot of people are saying that the shoes are very comfortable. They've made some adjustments. So if it is picked up in terms of anything like we've seen, like the women's shoe, like Julie was just talking about, it could be a good news here for this company.
Let's put some dates on this, too. You got the Beyond Feel running shoe. That's set to launch March 19th. And then you've got the Beyond Feel. Everything is feels and beyonds with Lululemon. This one is going to launch May 7th here. So we'll see what type of contribution.
That's the trail running shoe.
The trail running,
that launches on May 7th. Yeah.
And it's going to be available in North America, Europe, and China, too. So we'll see what demand looks like. All right, keep it right here on Yahoo Finance. Much more on the other side of the break.
Shares of Qualcomm pulling back slightly today despite reporting a return to growth in the handset market and also beating Wall Street estimates in its first quarter results. Joining us now to dive into the numbers and investor reaction is Akash Palkhiwala, Qualcomm's Chief Financial Officer and Chief Operating Officer. And first of all, Akash, congrats, because now you're wearing both of those hats as CFO and COO, which is this is the first time you guys have reported earnings where you have both of those roles. So good to talk to you.
Good to talk to you as well, and thank you for the wishes.
Of course. So let's talk about smartphones first and the rebound in smartphones. Now, you're not looking for a huge rebound in demand for smartphones. You're looking at flat to up slightly this year. But what is driving that rebound, and what could sort of go even more right that would make that rebound larger?
Sure. So I think the smartphone story is less about just the unit growth, but more about the content growth. If you look at the consumer and how they use their smartphones, they are demanding more and more use cases, and they're spending a lot more time with the phones than they used to even a couple of years ago. So what that means is when people buy a new phone, they're buying a more expensive phone. And so we're seeing this tremendous mix shift towards more expensive devices, towards more expensive chips. And that shows up in our revenue growth. Even in a relatively flat market over the last several years, we have tremendously grown our content per phone, our capabilities that we have in any given device, and that shows up in our financial performance. And we're excited about that. That's a trend that's held over the last few years. And as we look forward, we don't see that changing. And then maybe on top of that, one of the other key drivers going forward is going to be the fact that generative AI, which has so far been running just in the cloud, we see a strong trend towards running that on the device. And it's no different than computing. Computing runs at both places, in the cloud, on the device. And we see that generative AI will also go through the same transition. And that will create more opportunity for us in terms of competitive differentiation, maybe drive an upgrade cycle for phones as well, and then more content as well.
Dig into that a little bit, if you could, for me, Akash, because you talked about this a little bit on the call, that we're already seeing some of those capabilities on device for some of these phones, translation, for example, that we're seeing happen on the phones. When would it get to the point, though, that it would drive an upgrade cycle, for example?
So the first set of devices with initial capabilities on Gen AI just got launched, right? So Samsung just launched their GS24 device. Very excited about working with them on that device. And if you look at some of the key features they're highlighting in the devices is all around generative AI and how you can use that to change the way we interact with the phone. The user interface, we think, will completely evolve based on generative AI capability. And then how you do certain things on the phone, things we couldn't do in the past, like language translation and do different things with photography as well. Which are just incredible use cases for consumers. And so over the next 12 months, as new phones get launched, you're going to see a lot more use cases come through. And this is one of those things where you can add functionality even after the phone is in the consumer's hands. So I'm excited about what happens over the next year or so. And I think that's going to drive a lot more interest and upgrade cycle within phones.
Let's talk PCs as well, because you guys have some new chips coming out that are meant to go into PCs and other devices for that matter. What does early demand look like for those chips? And then on top of that, how do you think demand for PCs is going to look this year?
Yeah, so we think of PC as a market that's going through a transition. They are going to go from the PCs that we've been using in the past to an AI PC era, and which is a completely kind of a inflection point in the PC market. We're fortunate that we are right at that inflection point. We bring in the right set of capabilities, not just in terms of the best-in-class performance on the CPU and the GPU, but also bringing in our neural processing engine, which is key to running AI use cases on the device and then in the cloud as well. So it is something that we are very well positioned with our portfolio, technology portfolio that comes from phones, and it allows us to exploit this inflection point in PCs. We expect these PCs to start launching in middle of the year and devices with our chips ready for back to school and then going into the holiday season. So excited about it and anxious to kind of get the products out and into the hands of consumers.
And Akash, finally, I want to ask you about China, because you did see relatively strong demand in China. And I'm just wondering how investors should think about that and how they should square that with all the headlines that we were seeing about a weakening, or weakish at least, Chinese economic environment. But it sounds like people are still buying a lot of phones over there.
Yeah, I think it's not just the number of phones that are being bought. What we saw in the quarter was we launched a new chip, Snapdragon 8 Gen 3, and there was just tremendous demand for that chip across all OEMs, Chinese OEMs as well, but also Samsung and the other global OEMs. And what happened is, because of the capability of the chips, we saw the OEMs being extremely aggressive with their launch plans, bringing in Gen AI use cases, and you're seeing the benefit of that show up in our numbers.
Akash, thank you so much. Got to leave it there. Akash Palkhiwala, really appreciate your time. Qualcomm CFO and COO. Have a great day.
Thank you very much. Thanks for having me on.
We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
Senator, our job and what we take seriously is making sure that we build industry-leading tools, find harmful content,
make money.
take it off the services,
To make money.
and to build tools that empower parents.
So you
that
didn't
help
take take
working
any
moms.
action. You didn't
That's
take
not
any
true,
action.
Senator.
You didn't fire anybody. You haven't
That's not
compensated
true.
a
That's
single
not-
victim.
that's
Let
not
me
what I
ask you
said.
this. Let me ask you this. There's families of victims here today. Have you apologized to the victims? Would you like to do so now?
Well,
they're here. You're on national television. Would you like now to apologize to the victims who have been harmed by your product? Show them the pictures. Would you like to apologize for what you've done to these good people?
Tense hearing yesterday on Capitol Hill. Meta CEO Mark Zuckerberg apologizing to families during yesterday's Senate hearing as lawmakers grilled social media executives about online child safety. Joining us now with their insight into what we heard yesterday and the legislative efforts going forward, we want to bring in Senator Marsha Blackburn, as well as Senator Richard Blumenthal, both authors of the Kids Online Safety Act. Senators, thanks so much for taking your time to join us here this morning.
Thank you for having us.
Senator Blumenthal, let me start with you because tension was very high, like we just heard in those videos, very dramatic moments during the hearing yesterday. Walk us through just your insight or your takeaways from what you heard from these CEOs yesterday and whether or not you are more confident now that you know how to fix or best address the issues that are facing social media giants today.
I feel more strongly than ever before that we simply cannot trust big tech to impose the kinds of safeguards that kids need against bullying and harassment, eating disorders, suicidal self-injury, all the toxic content that they are driving at our children because it's part of their business model. They're making money because more eyeballs, more addictive content mean more advertising and more dollars to them. And so I think more than ever, I feel we need the Kids Online Safety Act to make sure that these tech executives are held accountable. And I will tell you that as much as Mark Zuckerberg may have felt good about apologizing or seeming to apologize, actions speak louder than words. And the actions of these tech companies is essentially to ignore the harm that they're doing and fail to act responsibly. That's why we need to pass this legislation.
Senator Blumenthal, of the tech CEOs that were present yesterday, did any of them give you confidence that they would be able to make the necessary changes?
So far, none of them have made the necessary changes. Whether they will in the future, I don't want to say they can't, because certainly they can. I don't want to say they won't, because maybe they'll start moving in the right direction as a result of this public pressure. Snap and X, along with Microsoft, now have endorsed this legislation, a sign of the momentum that we've generated. But most important, the parents who were there in that room. That picture is worth 1,000 words. And they are going to make sure that we get this legislation across the finish line because we can't count on big tech. They want to spread this mandate of trust us, but we can no longer trust them.
Senator, are you confident you'll be able to get bipartisan support for this legislation?
We have bipartisan support for it. Almost half the United States Senate, 50 senators from both sides of the aisle, now have co-sponsored this bill. And there's nothing partisan about, unfortunately and tragically, losing kids to suicide or bullying or harassment or eating disorders. It affects red states and blue states and parents, regardless of however they feel about political candidates or partisan causes.
And Senator Blackburn, thanks so much for sticking with us and us working through some of those audio issues. I'd love to get just your perspective from what you heard yesterday from the social media CEOs, just in terms of whether or not you think the CEOs understand the scope of the problem and what is necessary and needs to be done in order to address these tragic issues that unfortunately have happened as a result of things that have taken place on their platforms.
After yesterday, I think some of these social media CEOs have come to realize that the American people are tired of them using children as their product. Teens spend about 8.5 hours a day on their devices. And when they are on these platforms, they're the product. They're producing data. The longer a platform can keep a child on that platform, the richer that data is. Then they make more money when they sell that data to advertisers. And the room full of parents that were there yesterday, the parents that are here to advocate for the passage of the Kids Online Safety Act, this is changing the expectation from these social media platforms, they are realizing they are going to have to design for safety, that they're going to have to put protections in place, be certain that parents and kids have a toolbox so that they can disable some of these algorithms. So it may have been the Wild West for a lot of these folks that run these social media platforms, but that is changing, and it is because of the advocacy of these parents and also of friends that are doing this in the memory of one of their friends that this is going to change.
Senator Blackburn, politicians are also some of the spenders in terms of the campaigns that are run and advertisements and marketing efforts that are run on all of these social media platforms. Are any of your constituents or any of your colleagues willing to pause and take that step of even pausing campaigns until you see the changes that you would like to on this front from social media companies?
One of the things Senator Blumenthal and I have talked about regularly as we have worked on this specific legislation, and others of us who have worked on privacy, online privacy, we have talked about how you have the army of lawyers and lobbyists that fight us on putting in place this regulation. And they're fighting because addiction is their business model. They have to have eyeballs locked on those screens in order to get their way, if you will, and to continue their existing business model. And truthfully, I think that business model is going to have to change because people are not going to spend that amount of time or allow their children to spend that amount of time locked on the screen every day.
But you're saying you would still continue to spend on campaigns despite not seeing what you want to from these companies?
What we are focused on is having the companies respond to protecting children in the virtual space. At this point, there is no regulation that is in place that would protect children in that virtual space.
Senator Marsha Blackburn and Senator Richard Blumenthal, thank you for taking the time to break down what's in the bill, and we'll see ultimately what comes next from these companies and if they respond. Appreciate it.
Thank you.
Thanks. Switching gears here, Elon Musk is saying that he'll be moving Tesla's incorporation to Texas after holding a poll on X. This comes after a Delaware judge shot down his $56 billion pay package on Wednesday, calling into question Musk's relationships with the board. Let's bring in Yahoo Finance's Alexis Keenan to give us the details here. Hey, Alexis.
Hey, yeah. So in a post today, actually in the early morning hours of February 1st, Musk had posted to Twitter saying that the vote is unequivocally in favor of going to Texas and saying that he will move for a shareholder vote to transfer Tesla's incorporation state. So he'll first need to vote on that. He can't just do it unilaterally. Now, this Delaware decision at the heart of this matter, it invalidated that $56 billion compensation package for Musk. It's based on Delaware law, and that's important here because those laws require directors and officers to regard certain fiduciary duties. The judge in this case said that Tesla's board failed in their fiduciary duty, but the decision may have been a lot different had this case come down in Texas, in Nevada, where these places where Musk has other dealings with his other companies already, in addition to Tesla's physical presence. Now, go back all the way to 1987, you have Nevada changing its laws to allow companies to waive all three of these directors and officers' duties: the duty of care, the duty of loyalty, the duty of operating in good faith. Now, the goal then was to entice companies away from incorporating in Delaware, come to Nevada, where they think business would be more liability-free. It even led to a satirical piece in The Onion back in 2002. See, I can't even say it anymore. That said that Nevada was going law-free, calling it a liability-free state. But then Delaware did, in part, follow suit. Delaware did away with one of those duties, and they permitted companies to go ahead and waive directors and officers' duty of care. Now, that didn't save Musk in this case with this particular judge in Chancery Court, but also you have to look at Texas. Texas has a more case law-based structure for these duties. They still, though, impose all of those duties, duty of care, loyalty, and good faith. So whether or not this is the best place for Musk, that is a question at this point.
Alexis, thanks so much for continuing to track this. We'll see if they successfully incorporate in Texas. We know you'll be tracking it as well here.
Still got a ways to go.
Yeah, indeed. Our own Alexis Keenan. Another major story that we're tracking here this morning, another 3 big tech companies reporting earnings after the bell this afternoon. Apple, Meta, and Amazon. And investors are speculating how much impact the results will have on markets here, given how important the Magnificent Seven rally has been since the end of last year. Let's get to Jason Benowitz, who is the Corient Roosevelt Associate Partner and Senior Portfolio Manager, to discuss more. Great to have you here in studio with us. When you think about what we could potentially hear from these companies that perhaps add some fuel to the rally that we had seen since the end of last year, what would these companies need to come out and say?
Sure. So, certainly investors are expecting to hear positive things from the companies. And I think as an example, if we take Amazon, so we think Amazon, could potentially provide good results that could catalyze the market higher. And it's because if you look at the different segments of their business, so for example, retail, we know that broadly retail had a good sort of holiday shopping season that was driven by e-commerce, and that could drive North American retail at Amazon. And then if you think about their cloud business, here again, we already heard from Google and from Microsoft that cloud business has accelerated at those 2 companies driven by AI. It could be that investors think that this is not quite as applicable to Amazon, and so if they deliver the same sort of result, that could be a driver. And then thinking about Apple, so Apple, we feel like the setup is positive because they've guided to only having flat revenue growth in the quarter, which we think is achievable. And then if you look at what the street consensus is for Apple for the following quarter in March that they're going to guide to, here again, only up 1%, something we think the company can achieve. So overall, we feel like, yes, the stocks have run, but the estimates seem reasonable, and there are things that the companies can meet or exceed when they report.
Yeah, Jason, when we heard from some of the sell-side analysts since the start of the year, you had Barclays downgrading the stock, as well as Piper Sandler talking about that demand issue that Apple has when it comes to the iPhones. And they also made the case that the next generation or the next iteration of the iPhone won't be too different from the iPhone 15 in terms of that demand. It won't really be enough to excite people to get off the sidelines and really upgrade their phone. How big of a cloud or how big of a risk do you see that being to Apple, at least in the short term?
Yeah, so Apple will need to show growth in the iPhone segment when they report, and that's an interesting point of contention for investors. So we think China will probably be a source of weakness. We think it declined last quarter. The decline might even get worse in the current quarter when they report because of Huawei being a stronger competitor than they were 6 months ago. But on the other hand, in the developed world, the US and Europe, we see sort of a higher mix shift, so people buying more expensive phones being a driver. We think the company might be gaining share in emerging markets, and overall, we think they can deliver that iPhone growth that investors are looking for.
Okay, and so what can these tech earnings also tell us about the state of the consumer right now as we're continuing to kind of pour through inflation data, retail sales data? Of course, all of this is kind of what's leading us to try and figure out what the state of the economy is. But as per these companies, what is the state and the health of the consumer?
So as I was referencing with respect to Amazon, I think that the fact that the consumer went shopping in the holiday season and furthermore used e-commerce, that was a particular source of growth for the industry broadly. I think we'll see Amazon get at least more of their fair share of that growth. On the other hand, if we look at Meta and sort of the advertising business, now we've already heard from Google, and investors were somewhat disappointed with sort of the search and YouTube advertising that Google reported, and so I think that's probably a good read-through to Meta, and so there's some risk there. What could counteract that at Meta is company-specific initiatives, for example, monetization of the Instagram Reels product, but overall that might be a source of concern, and actually, when Meta sort of provides their guidance for the following quarter, we might get a sense as to whether we think advertisers are they willing to sort of spend in 2024 at the beginning of the year, or are they themselves concerned about whether the consumer strength would merit that?
Yeah, certainly whether or not their year of efficiency is going to be able to really help them navigate some of these headwinds ahead. All right, Jason Benowitz, always great to have you. Thanks so much for joining us here. Thank you. All right, keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29.
Despite a seemingly bumpy road ahead for EVs, electric vehicles, Volvo is plugging into the space, doubling down on its goal to go completely electric by 2030. The automaker saw its EV sales jump 70% in 2023 from a year ago, representing 16% of its total global sales volume. Volvo also announcing it is evaluating a potential adjustment of its shareholding in Polestar. For more on the space and the company's performance, we've got Bjorn Anwal, who is the Volvo Cars Chief Commercial Officer and Deputy CEO, joining us now alongside Yahoo Finance's Pras Subramanian. Okay, Bjorn, we got to get into this. What are you guys doing differently, seeing differently in how you're showing up to the EV space versus some of your competitors that are trying to break the mold here?
One thing that we're doing different than many others is that we have a sole focus of becoming a fully electric company in 2030. And that means that we have done a lot of structured investment into that space for many years now. And that's what you see in our numbers now, where we grow, as you said, 70% year over year, and increase the gross margin in doing so. And I think one thing it's important, Volvo is a premium brand. We're focusing on the premium end of the EV markets, and that's where I think you can see quite strong margins. A lot of the discussions on softening EV margins and softening EV demand, we don't see for Volvo.
Hey, Bjorn, Pras here. So you guys are introducing 2 more EVs to the portfolio this year. What do you think is making that situation work for you, especially in the U.S.? Why is there traction here for EVs where other companies have not been able to do the same?
Well, clearly, the move into a fully electric world will happen with different timescales in different parts of the world. I think even within the U.S., different states are moving in different paces. Clearly, the West Coast in the U.S. is moving faster than maybe the interior. And we have a portfolio of both fully electric cars, but we also have great plug-in hybrids and mild hybrids. So we can play a different audience in different states. And that's really the strength of Volvo. And what we see happening now in the US is really how plug-in hybrids are taking off. And many consumers see that as a bridge into a full electric future. I mean, maybe you don't trust to have a full electric car as a full step. So they try with a plug-in hybrid as a first step, and the next car is a fully electric car. We can see from the charging data on our cars that more than half of the energy consumption in the car comes from charged electricity, meaning that plug-in hybrids are actually charged very frequently and are more used as a fully electric car than an ICE car. So also in America, we clearly see that there are many consumers who want to go into a fully electric future.
So Bjorn, I know you offer cars like the XC40 that are both hybrid and fully electric. Are you seeing that in Q4 that there's being a shift from buyers going from EVs to hybrids? Is that actually happening for Volvo as well? We've seen with other brands too.
No, we continue to see a strong growth on electrification, both on the plug-in hybrid side and the full electric side. As I said, 70% growth this year, and we are now having 16% of our sales globally being full electric, a number that will significantly grow over the next year and coming to 50% already in 2025 on the back of launching the new EX30, which is a small premium SUV, and the EX90, which we will produce for global consumption out of Charleston, South Carolina.
And let's talk about the news also that came out in terms of the plans here to stop funding Polestar. And of course, this comes and it kind of sparks some chatter amongst the street just in terms of the timing of this, if there's any read-through about what this signals in terms of demand for EVs. Walk us through that strategy and why this makes sense for Volvo.
Polestar, firstly, we're extremely proud to have founded Polestar. It has built a very strong brand, and they're now going into a new phase of their development where they're going from being a one-car brand into becoming a three-car brand, launching the Polestar 3 and the Polestar 4 during this year and starting to ship that to consumers. Volvo Cars is going through a major transformation into kind of a full electric future, but also moving into a quite different car architecture based on core compute architecture and software-defined vehicles. We, as Volvo, need to focus on that transformation. And we're really an operating company, not an owner company. So what we announced now that we're going to evaluate is a way in which we, through some method, maybe dividend, maybe another method, will take down our ownership share in Polestar, and instead Geely Holding will assume the main owner responsibility for Polestar. They're set up to be a holding company, an owner company, and they're better equipped to be an owner company as Polestar move into the next phase. But important to stress is that Volvo and Polestar continue to have a lot of valuable collaboration, be it in engineering for the next generation vehicles, be it in production. We are both producing in our production facilities in Charleston, South Carolina, or be it in commercially to kind of have synergies in our retailer networks and so forth. So we are very much looking into how we can continue those synergies moving forward. So the operative collaboration is not affected by this announcement. The only thing we're announcing is that Volvo will no longer play the main owner role for Polestar.
All right, Bjorn Hanwald, we appreciate you taking the time. Volvo Cars, the Chief Commercial Officer and Deputy CEO. And our thanks, of course, to Yahoo Finance's Pras Subramanian as well.
Thank you.
All right, let's do a quick check of the markets before we let you go. You're seeing green on the screen, a bit of a rebound after yesterday's Fed sparked sell-off here. You're looking at the Nasdaq up just about 0.4%. The S&P holding on to gains, the Dow just above the flat line. That's all from us today, but keep it right here on Yahoo Finance. And Kiko and Rochelle have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's a look at what we're watching this morning. Big tech front and center once again this week. Apple, Amazon, and Meta all set to report earnings after the bell. The results come after a weak start for the tech megacaps this earnings season amid lofty AI expectations falling short.
And from Wall Street to the Federal Reserve, central bank officials voting to hold interest rates steady in January. Investors looking for hints about when to expect loosening of monetary policy. We're tracking market expectations for what's ahead.
Meanwhile, widespread disruptions leaving shipping companies scrambling to find alternate routes. We'll dig into what this means for shipping stocks coming up this hour.
First, though, let's take a look at where markets are trading right now. Looking for a bit of a rebound after that sell-off we saw yesterday on the back of the FOMC decision here. The Dow trading pretty flat right now, down just slightly. The S&P 500 up 10 and the Nasdaq up 52 points. Let's take a look at where Treasury yields are right now. Of course, a lot of investors looking ahead to that big jobs report to come out tomorrow. The 10-year yield right now pulling back at 3.87%, while on the longer end, we're seeing the 30-year yield at 4.10. Well, the pressure is on for the three Magnificent Seven companies set to report their latest quarterly results after the bell this afternoon. Investors will be scrutinizing every word from leaders at Amazon, Apple, and Meta after the first three Mag 7 members, Tesla, Microsoft, and Alphabet, failed to impress investors. We have our very own tech reporter, Dan Halley, with us. Dan, and we should say expectations are sky high. We've learned that from the other companies that have reported so far. What should investors be watching this afternoon?
Yeah, Kiko, expectations are sky high. I mean, Microsoft had a great report, and you saw shares fall off. And then as far as Google, Alphabet goes, they missed on ad sales, and you saw what happened. They were getting hammered as a result of that. But as far as Apple, Amazon, and Meta, let's go over some of the big numbers that people are going to be watching. Revenue and earnings per share, $2.11 on $117.9 billion for Apple. That's the big number. But the number that most people are going to be watching is iPhone revenue. That's expected to come in at $68.6 billion. That would be up from the $65.7 billion they reported in the same quarter last year. And that's important because we've been getting reports from different analysts saying that overall in China, iPhone 15 sales are sluggish, and there's a number of reasons for that. A resurgent Huawei, which is offering high-end phones at a cheaper price that can rival Apple, as well as the slower economic outlook in China itself. So there's a lot of kind of rumblings there. There's also some issues with the Mac and iPad line. As far as Meta goes, we're looking at earnings per share of $5.05 on revenue of $39 billion. The big number there that we're looking at is advertising revenue. That's expected to be $37.8 billion in the quarter, up from $31.3 billion. Advertising has really rebounded from Meta over the past few quarters. They seem to have figured out how to get around Apple's app transparency tracking or app tracking transparency. That really put a dent in their advertising, as well as the interest rate issues that we had seen where advertisers had pulled back. And then as far as Amazon goes, we're looking at adjusted EPS of $1.04 on revenue of $166 billion. And of course, the big item we're going to be looking at here is AWS, Amazon Web Services, with expected revenue of $24.2 billion. The generative AI, general AI conversation that we're seeing really does feed into cloud services like AWS. If you look at what Microsoft had announced during its earnings, its Azure and general cloud services got a jump from AI. They said the intelligent cloud segment, which includes Azure, had a 6% revenue bump from AI. That was up from 3% in the prior quarter. So you're seeing AI take hold for them. We'll have to see now if generative AI and the spending that Amazon has done on its own chips, inferencing, things along those lines, start to pay off for AWS.
So Dan, it's interesting because these are three very different companies. Obviously Meta, based in social media, then expanded into devices. Apple, you think devices, software, and then you have Amazon, a bit of consumer, a bit of everything. How fair is it to stack them up against each other?
I think, there's competing services across them all. Advertising is a big piece of each of those three companies. You might not think of it with Apple, but they generate a lot of advertising revenue. Meta, they're chiefly advertising. And Amazon's advertising is huge now. It's a mega part of what they have to offer. And then, there's other pieces where they compete with each other. Obviously, Meta and Apple are now going head to head starting tomorrow with the launch of the Vision Pro headset. For Meta, that could be a good thing. While, Apple is getting all of the fanfare because of the headset, it's interesting. It's a new Apple product that's generally going to generate a lot of buzz. It's $3,500, $3,499. A lot of people aren't going to be able to afford that. And some analysts are expecting perhaps a knock-on effect on Meta's headsets, the Quest 3, which is significantly cheaper, but offers an AR/VR experience like Apple's. It's not as good. The technology isn't nearly what Apple has to offer, but people can get a general sense of what AR and VR has to offer. I think the key thing for both of these companies when it comes to these devices is keeping people hooked. We've seen that Meta's had a problem with that, with some executives saying that people 6 months out don't necessarily stick around. And so for Apple, that's going to be a big deal. And then for Meta, if they do get that knock-on effect, that's going to be a big deal. And obviously, generative AI is playing a part across the entire industry, Amazon being a big part. Meta is looking to get general artificial intelligence. That's what Mark Zuckerberg said, spending billions of dollars on NVIDIA AI chips. And Apple is reportedly expected to get into the generative AI game for consumers in the next version of iOS. So they're working on that in the background. There's been reports of that for some time now. So they really do compete across a number of industries. It just feels like they're so different because of what the companies really are when you look at them as a monolith.
No, you raise a fair point there. Appreciate that breakdown, our very own Dan Howley. Well, of course, big tech companies once could do no wrong. Now investors seem to be holding them to extremely high standards. The first three Magnificent Seven companies to report saw their stocks punished for their minor misses and less than mind-blowing forecasts. Beats on the top and bottom lines aren't even being rewarded anymore. With Apple, Amazon, and Meta on deck, what could the market have in store next? Joining us now is Daniel Morgan, Synovus Trust Senior Portfolio Manager. Good to have you on the show here. So we've come from a point of, you could barely find a bear on Wall Street when we were coming into that December tech rally. But where are we now that we're sort of marinating on some of the misses that we saw in the outlook for Microsoft and Google, and now heading into the rest of the Mag 7?
Well, it's interesting, Rochelle, because, obviously Tuesday we had Alphabet come in with numbers. As everyone knows, and you've reported, and you just discussed, they missed on advertising revenues. YouTube revenues were up about 15.5%. GCP, which is their cloud service, was up about 25%. So we kind of take those numbers and we roll those into Meta. We know that consensus, as you just mentioned, is looking for ad revenues up 20%. So that's double what we saw from Alphabet. And then we also roll that GCP number into AWS. And we're expecting AWS, which is Amazon's data center service, to be up roughly about 13%. So those are the kind of numbers we derive from that. And then, as you were talking about earlier, everyone's trying to see some more evidence, Rochelle, that we're getting some sort of impact from AI. As you mentioned earlier on the Microsoft call, they said that Azure was up 30%. 6 percentage points of that came from AI-related tools. So we're trying to see if we can get that same effect coming out of, let's say, Amazon with AWS, where we're all looking for 13.5% growth, but they beat the number. And the reason that they beat it was because of the enhancement tools using AI. So again, Rochelle, we're just looking for more evidence that AI is coming to fruition and it's actually pouring down to the bottom line in terms of profits, opposed to just a bunch of talking points on a conference call.
Well, Daniel, I guess the question for me is, how much strength do these companies need to show in order to push that stock a leg higher? You look at somebody like Microsoft. I mean, you broke down the numbers for Azure, but overall, they were up in terms of expectations, key metrics, and yet we saw that stock fall. So how much of that is about profit taking, this expectation that this is as good as it gets, or how much of this is about disappointment in the financials?
Well, you're right. I mean, the tech stocks are priced to perfection right now, and there are a lot of people kind of scratching their heads in regards to how long can we talk about AI? How long can we talk about all this CapEx that you're going to spend on it? And when do we start to get back results? So I think you bring up a good point, which is we know that Microsoft hit the $3 trillion mark a couple weeks before they had their report. Stock really ramped up. Everybody's very excited about it now. Is in the same camp with Apple. But yeah, it does seem like there isn't a lot of room for error. Not only do you have to hit all your numbers, but you got to give us something more. And Microsoft really did deliver that. And yet, kind of like Alphabet, the stock price afterwards was kind of muted. So it does seem to me that the stocks have gone up so much in value. The expectations have been so high related to AI that when the companies do report, even if they do a great job, the stocks pull back. So there's just not a lot of room for error right now in the Magnificent Seven.
So Daniel, whose technological roadmap of the three that are reporting today do you like? Obviously, we saw Meta bet big, changed its whole name, and then the metaverse didn't pan out. Will they be in a similar situation here?
You're right, Rochelle. I mean, everyone's got a roadmap, right? Apple's got a roadmap. Just about everybody that's going to be on these calls today, Amazon, Meta, they all have these AI roadmaps, and they all have very similar products. Most of them have a chatbot. A lot of them are trying to develop their own chips. You can go and look at MTIA, which is the Meta chip. Everybody's trying to, Amazon's doing the same thing. Alphabet has a Tensor unit. But right now, I think if the leaders of the pack in that space that to me have the best roadmap would be Microsoft. Obviously, on the software side, we're already starting to see results in that Acer number. And then, of course, we've talked so many times on the show about NVIDIA. NVIDIA is just knocking it out of the park right now with their H100, A100 chips and their Grace Hopper 200 chips. Those are their AI chips that they sell for $20,000, $30,000 a piece. And we've definitely seen a huge impact on their bottom line. And a little bit with AMD also with the MI300. A and MI300X. They just reported last week and had a great data center numbers up 38%. So to me, those would be the leaders right now. The other guys are trying to kind of get that roadmap and starting to try to show actual profitability from their endeavors, opposed to just kind of talking points.
So Daniel, given everything you said, are you adding more exposure? Are you buying up more of these Mag 7 stocks?
I think at this point, you got to create an opportunity for yourself, and that will happen when the stocks pull back. I mean, those stocks that we're talking about today, they're all on our buy list. They are stocks that we would look at to purchase for our investors that come in with the proper time horizon and risk objective. But I think, I would wait for the share prices to pull back a little bit and try to find some opportunities. These stocks have traded up so much since last year. They were up 45, 50%. And they've been, I think the tech sector is up about 6% year to date. So it's been a relatively strong sector over the last 12 months. So obviously you want to look for a dip in the share prices, get a big sell-off after an earnings report or something, try to find an opportunity. But I do believe that the fundamentals are still intact in these names.
Daniel Morgan, Synovus Trust Senior Portfolio Manager. I know you'll be watching after the bell today as well. Thanks so much for joining us today.
Thank you.
Taking a look at today's trending ticker, we are watching shares of Octa up just slightly here on news it's cutting 400 employees. That's roughly 7% of its staff, all part of a restructuring plan, according to the company. It's estimating it will take a $24 million hit in its fourth quarter from restructuring charges. Rochelle, it has been a tough week. When you think about all of the job cut announcements that have come through, we were talking about UPS earlier this week, 12,000 job cuts, PayPal cutting 9%. Looking at the total today, this year alone, roughly 29,000 tech jobs cut so far. And the story we're hearing out of Octa seems like something we've heard out of other companies. It's efficiency. It's about overhiring, trying to save costs, but certainly still a tough day for employees.
It's true. I mean, and looking through the details of that 8K filing with the SEC, I mean, he really does talk about some of the overhiring that they had before. When you look at where the share price was in 2021, peak of the pandemic, $290. Looking at it now, sitting at about $83. So clearly, off those peaks, they overhired to meet that demand of everybody sort of working from home. But then they cut those 300 jobs last year, and then an additional now 400 being announced here. And then also having to contend with some of the data breaches, some to some of their customers with their support case management system, and then separately a hack last year of MGM and Caesars as well. So really trying to I guess they're holding their feet to the fire here, trying to cut costs where they can, and still continuing to see these pandemic overhiring hangovers continuing to linger.
Yeah, the CEO, Tom McKinnon, there saying that costs are still too high. He says this is about growing profitability, that the company needs to run a business with greater efficiency. Feels like something we've heard from other companies as well.
It's true. Unfortunate indeed. Well, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Fed Chair Jerome Powell quieting expectations for a March rate cut on Wednesday, saying he doesn't expect the FOMC to reach, in his words, a level of confidence in the path of inflation by then. That's prompted investors to look to May, with more than 60% pricing in the first rate cut then, according to the CME FedWatch tool. For more on how to position your portfolio ahead of that, let's bring in Adam Hetz, Janice Henderson, Investors Global Head of Multi-Assets. Good to talk to you today. Let's start with what we heard from the Fed chair yesterday, because this issue of him saying we don't feel quite confident just yet in beginning those rate cuts. As you see it, what are the key risks to reacceleration of inflation that you think could really shift the narrative?
Good question. It's a busy week, plenty to talk about today, including the comments from Chair Powell. So I think the risk here, it's not so much about reaccelerating in a sense, it's at the very least sticky, I think, is a good base case expectation if investors are going to kind of plan for the best plan for the worst and hope for the best. I think planning for the worst is maybe reacceleration or at least sticky, but I think this is a really healthy reminder this week for investors that we are dealing with the long and variable lags, that infamous impact of all these interest rate hikes we've just lived through. So I think this is a reminder that going through this year, we're likely going to have a lot of hot and cold, kind of stop and go economic readings and commentary spread throughout from Chair Powell and others. And so for portfolios, it means staying invested, but I think being a bit cautious and being defensive and being very active as we navigate all the hot and cold stop and go readings.
And Adam, Rochelle here. So then if you're the Fed and you're seeing, continuing to see strong economic data showing, the market, the economy really can deal with this holding pattern right now, what is the incentive to cut?
The incentive to cut, I think it's a reasonable premise for investors to think there's going to be cuts this year. Maybe not March, that might have been a little bit optimistic. The bigger question to us is what kind of cuts are we going to get? Because to your point, well, what is the motivation to cut? So to us, there's these chain reactions of those high interest rates transmitting through the economy, and that's going to result in cuts in one way or the other. So one cut could be this immaculate disinflation kind of adjustment cut, which is all is clear, 5.5% is relatively restrictive. It's historically restrictive in nominal and real terms. So that's one type of cut to say that's too restrictive. Things are moving along. They're slowing down on their own. That immaculate disinflation, that's great. The other cut is that recessionary cut. Maybe those chain reactions of these restrictive rates filtering through the economy and then create a recessionary spiral. And then that's the motivation for the cuts. And we're not out of the woods yet. And I think for all the talk about soft landing, I think Q4, the word hard landing totally fell out of the equation. And that to me was a little premature. And I think going into this year, we've seen a reversal of that Q4 broadening. And that's that healthy reminder that we're likely still somewhere between soft and hard landing, and investors should be positioned accordingly.
So what does that positioning look like? We're not necessarily taking a rate cut off the table, even if the timeline's been pushed back, but you're saying that risk between a soft and hard landing still exists. So how do you put together that portfolio?
And how to thread that needle, because if I'm talking about a soft landing, immaculate disinflation on one side, and then the hard landing, recessionary cuts on the other side, those are polar opposite outcomes. And you can't position portfolios on one extreme bet or the other, at least not sustainably, and certainly not for medium or long-term investors. So our view is still staying invested, erring on the side of caution. I think there's not just one elephant in the room. There's two big elephants trying to squeeze into the room. So one of which is Magnificent Seven and the historical amount of concentration we have. That's running about 30% of the S&P 500. The top seven should be more like 20% historically. And it's not just the US. Thinking globally now, that Magnificent Seven tech concentration, that's making portfolios historically concentrated in the US compared to the rest of the world. The US is about 70% of global developed equities as measured by the MSCI World Index. Just 30 years ago, the US was more like 30%. So we've got a historical concentration within the US. We've got a historical concentration in the US on a global stage. So that's one elephant in the room that investors need to navigate on the equity side of their portfolios. And the implication to your question is broadening outside the Magnificent Seven. So to us, that's embracing what there is to love in the Magnificent Seven, and there's a lot. There's strong earnings, there's quality, stable earnings, there's the AI exposure, there's interest rate sensitivity in a good way in this environment. But you can also find those aspects in parts of the other 493. But just be careful, because as you broaden out, you get more value oriented, you get more cyclical. So be very selective. As you go way down in cap to small cap, 40% of those are unprofitable. That's also a historically high number. So be active, be selective, look for that quality growth as you're going down in cap in equities and going international as well. That same playbook applies. So that's one elephant in the room. That's the concentration within equities. That other elephant squeezed into the room is these historically high cash balances in portfolios. And investors were seeing the most anticipated recession ever coming supposedly a year ago, and investors sold out of some equities and went to cash. You underperformed by 20% last year if you went from the S&P to cash last year. And that is really challenging, and investors are still holding on to those cash balances, and that feeds into the fixed income, or the 40 of the 60-40. And how do you work out of those cash balances and extend duration in fixed income portfolios?
So then, Adam, with that in mind, then, when do you expect to see a real sentiment change? I'm looking at the Bank of America sell-side indicator, which gauges strategists' sort of asset allocation views, and they recorded a shift in equity sentiment for the first time since October. Could that be like potential canary in the coal mine, especially in the thick of earnings season?
I think so. They do a wonderful job with that indicator. And where we're trying to be very timely and very high frequency with our own indicators, I mentioned chain reactions. I think one of our issues that we're taking with the broader market narrative is there are these very ambiguous long and variable lags impacting the market. And then you have these knee-jerk reactions between soft and hard landing, depending on different monthly economic data reads or comments from the Fed. So to us, our set of indicators is thinking about those chain reactions. And I would say there's four main links in that chain of these rates transmitting into the economy. So the first link in the chain is monetary conditions. We already said they're historically very restrictive right now in nominal and real terms. That's feeding into a lower willingness and ability to provide loans. So you're having this contraction in credit conditions, which then hurts corporations. And if corporations continue to hurt, and if they can't keep up with this very high bar of earnings expectations through 2024, then unfortunately what happens is payrolls will get cut, job numbers go down, unemployment can go up, and wages can get cut. And that hits the last link of the chain. Very unfortunately is the consumer, the backbone of US GDP. If 2/3 of US GDP is the consumer, and they're the last link in that chain, there could be a long lag, and that will feed right back to corporations. That will hurt their top line revenue. That can be that recessionary death spiral, which needs those emergency Fed cuts. Or the other outcome, again, it's soft landing. All this kind of happens, but nothing matters, and the market's up 26% again this year. But the point for us is, as investors, don't take an extreme view on either side. The luxury we have is you have indicators and you have data for every link of that chain. And that's what we're being very vigilant and watching. And that's what's going to inform us. That's how we calibrate model risk up and down throughout our portfolios this year.
As you mentioned, there are two very different potential scenarios that could play out. Appreciate you breaking down your insights for us. Adam Hetz, Janice Henderson, Investors Global Head of Multi-Asset. Thank you so much.
Pleasure. Thank you.
You're welcome. Well, Tesla is looking to put more made-in-America batteries in its cars, but with the help of a Chinese manufacturer, according to a Bloomberg report. We have Yahoo Finance's very own Pras Subramanian to break this down for us. So, Pras, walk us through this development here.
Hey, Rachel. Yeah, so Bloomberg reporting that Tesla is kind of setting up this new battery factory or facility here with a twist, right? So it's going to be at their Giga Nevada factory near Reno. Basically, CATL, the Chinese battery maker, is going to supply them with machinery to make these batteries. And what will happen is Tesla will own the facility, they'll own the machinery, they'll employ all the workers and bear all the costs. And they're only CATL employees that'll be the ones that set up the machinery. So on paper, it looks interesting, but this is a big political hot potato. Ford had a similar issue now that with the factory in Michigan, a lot of heat from Republicans mostly about how they're concerned that Chinese and other types of rogue actors will have access to IP, battery IP, get their foot in the door in America in a battery production point of view. So that's been a sort of an issue there. So will we see that happen for Tesla? We'll see, because it seems very similar to what Ford is doing with CATL in Michigan.
Pras Subramanian staying on top of all those developments for us today. Thanks so much. Well, all your markets action ahead. We'll be discussing the biggest tax bills at the Senate right now with Maya McGinnis, Committee for a Responsible Federal Budget President. That's coming up on the other side. Well, the House passing a $78 billion tax bill late Wednesday, putting Congress closer to expanding that child tax credit. The bipartisan bill is expected to help millions of low-income households, but it also provides key tax breaks to businesses. And now heads to the Senate. Let's get to our next guest, Maya McGuinness, Committee for a Responsible Federal Budget President, to discuss more. Maya, good to talk to you today. I can't help but note the vote here, approved by a vote of 357 to 70. It's not often you get bills like that today in such a polarized environment. What's your read on this bipartisan bill and its fate in the Senate?
It is not often that you get bills that have bipartisan support like that at all. And when you do, they are almost always debt financed. So one of the notable things about this is that this bill is actually offset. They have made the point that our debt is so large that new policies, whether it's spending or tax, should be offset so that they don't add to the debt. So that's even further progress. There's still a couple reservations I would point out about the bill, which is temporary tax policy is not the right way to do tax policy. What we really need is more certainty. But I think it does have broad-based support, and it may well pass in the Senate. There's not quite as much support there so far. There's still some reservations. But I think we could see this bill move forward and possibly become law by pairing the child tax credit with some business credit tax, some business taxes that are otherwise expiring or expired.
And Maya, as we look out in terms of what's not potentially being extended further, what sort of costs are we looking at there? Because I know that you noted that some of it might be understated at this point.
Yeah, exactly. So on one hand, I think it's really good that they made the effort to pay for this bill. On the other hand, we have seen temporary tax policies used as a gimmick for many, many years, and it's getting worse, not better. And that is definitely part of this bill, which would be paid for on a temporary basis. But if you look at those policies, which everybody intends to make permanent, their supporters all do, the cost of the bill could be as high as almost $650 billion over a decade. So I think we have to look at the actual intentions of the policies and understand that by sort of gimmicking them through certain time windows, we really could be putting huge amounts of pressure on the budget and in the next couple of years at a time where we can ill afford to do so because of the huge debt we already have.
Maya, you had a statement yesterday on the back of this tax deal, but also talking specifically about the potential expansion of the SALT deduction cap and your concerns coming along with that. Walk me through that and how you view that in the context of just where the federal deficit is today.
Yeah, that's right. I mean, so SALT is a very contentious issue because it affects people very differently depending on the states they are in. And there has been a strong push by people in high income tax states to do something about SALT. SALT was a really important policy that helped offset a tiny bit of the Trump tax cuts. They were clearly not offset. They added trillions of dollars to the national debt. But SALT was one of the really important pay-fors that was part of that. And there's been pressure ever since to undo it. We have real concerns about doing that in a way that would, again, add to the fiscal gap that we already have, and in a way that's also inefficient and highly regressive tax policy. So if we end up having that portion of the bill or as a sidecar pass, which unless I don't think it's going to be a very large tax cut for the wealthy. And again, here's the fiscal situation we're facing. We are facing a country that has not passed the budget for the year that we are already 1/3 of the way through, has debt that's about to reach record levels and interest payments that are the fastest growing part of the budget. We cannot be adding more to the debt, particularly in a period of high inflation. We should be bringing it down. So I have grave concerns about anything that would make the fiscal situation worse. By the way, we should actually focus on passing a budget before we do anything on tax policy. That should be the first step for any country, business, and certainly for the United States.
And we keep seeing those concerns about the country's fiscal health, whether it's from JP Morgan, from other economists as well. Black Swan author Nassim Nicholas Taleb said that the US deficit is swelling to a point that it would take a miracle to reverse the damage. In terms of solutions, being that Congress has gotten used to this sort of piecemeal approach to this and really kicking the can down the road. What could an actual solution look like?
Yeah, because I am searching for that miracle every day and I don't see it coming. We don't have the political leadership that's really pushing for this. The choices are hard and none of our politicians like to make hard choices anymore. We have kicked the can so long, down the road so long, that we are in a dangerous situation where we have our major trust funds about to be insolvent within the decade, and we are about to be spending more in interest payments than we do on the national debt. This is an emergency. The best way out, I can think, given the huge polarization in Congress and the propensity to sell free lunches, peddle free lunches instead of actual real choices on taxes and spending, is I think we have to put together a fiscal commission. I think it has to be really bipartisan, give the members a chance to dig deep and understand the huge parameters and risks of this fiscal situation we're in, build some trust between each other that they have so little of between the parties right now, and simultaneously educate the country about the real risks that go along with all this borrowing. I see a lot of people in the market starting to become very concerned, but I don't think there's a broad-based understanding in the country of these risks. And they are not just economic, they are about national security at this point. So I'm hopeful that something like a fiscal commission could lend the political cover to make some progress that we desperately need to do.
You raise a good point. I think a lot of times people look at the national debt, the fiscal deficit, and the numbers just seem so high, they just sort of put it out of their minds and, focus on their own personal economy. So definitely something that's needed. Appreciate your insights. Maya McGuinness, Committee for a Responsible Federal Budget President. Thank you so much.
Thank you.
Well, a new report points to waning enthusiasm for American companies doing business in China. The survey from the American Chamber of Commerce in China shows a quarter of businesses are planning to relocate manufacturing or sourcing out of the world's second largest economy. Members polled cited US-China tensions, uncertainty around Chinese domestic policy, and rising labor costs as key factors for the move. Now, despite those concerns, nearly half expressed optimism around their business operations in China, with 49% of members saying they expect to be profitable for 2023. And as we look at some of the wording coming out from the AmCham China President Michael Hart, he was saying, look, this is a wake-up call for the Chinese government. They will not stay long if they're not profitable. You don't go to China to break even. And that really does reflect this idea that a lot of investors who had invested in the market were expecting to get a better deal, but then seeing those margins increasing at this point. Akiko.
Yeah, I mean, this speaks to the conundrum that so many companies that do business in China have. On the one hand, you've got policies, questions about how open the market actually is, U.S.-China tensions. But then the benefit has always been you've got a very lucrative market, the world's second largest economy. It feels like companies are really starting to weigh whether, in fact, the benefits still outweigh some of the risks that are there. And this poll certainly points to that. I mean, you could argue that companies have had sort of a diversification outside of China policy, sort of China plus one, China plus two. Apple, a perfect example. They have a heavy presence in China, but they've been diversifying to other regions. And so it feels like this points to that type of trend continuing, just given the risks. Not completely out of China, but looking outside of China as a potential hedge, depending on what happens on policy there.
It's true, because they talked about either planning, nearly half of the respondents either pulling back on or not expanding in China. So essentially some sort of a holding pattern. I thought it was interesting they did note when it comes to tech and R&D, they talked about a tech decoupling and some of the data policies as constraints as well, which makes sense. You have, China wanting to have some of these more high quality motors that they can rely on in terms of growth engines versus, more speculative things like real estate. So, but it's causing obviously some issues with the US as we see them continuing to sort of butt heads over chips, over other sort of high-tech industries as well.
Yeah, tech continue to be the big point of contention there on policy. Well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Shipping companies are scrambling to find alternate routes as their vessels continue to face attacks from Houthi militants in the Red Sea. That's leading to widespread disruptions, with 30% of cargo headed for U.S. ports on the East Coast, typically passing through the Suez Canal. The Port of LA is looking to pick up some of the load, even as it faces a surge in shipments stemming from another disruption: low water levels in the Panama Canal. Let's bring in Gene Soroka. He's Port of LA's executive director. Gene, it feels like we're getting a lesson in how interconnected global shipping is right now when you consider all of the disruptions we've been watching. Let's start with the Suez Canal. What's been the direct impact on the Port of LA?
Good morning, Akiko. On the Suez Canal, limited. I just came back from a 4-city tour in Asia. Started off in India, then went to Vietnam and Indonesia. And what shippers and exporters are telling me is that they're starting to make some subtle moves to the West Coast, trying to avoid some of those hot spots, but not a deluge of freight coming our way. What I can tell you is that the Port of LA is running at about 75% of capacity. So for those companies that need assistance, we're here.
And so, Gene, I mean, the Port of LA, the busiest and largest port in the United States, how do you prepare for the potential influx as we are seeing some of these diversions coming from the East Coast ports?
Well, Rochelle, it's not going to be a huge surge. All of our simulation and from the Port Optimizer, our port community system, we can see upstream about 40 days before a vessel is arriving here in Los Angeles. So it allows us to prepare our great skilled labor, our land and machinery to get ready for cargo upticks. That said, the month of January will be very strong when the numbers are tallied, and February looks good, mostly on the heels of everyone preparing for traditional holidays in Asia, specifically Lunar New Year. So we're seeing that little bit of a bump, and leading into March, that'll start to squelch a little bit into our traditional slack season. But we're ready on the ground here in Los Angeles.
Gene, let me get back to those conversations you had in Asia. I realize the Port of LA is not going to get a huge surge coming out of the Suez Canal, but I'm curious, if some of those companies have to reroute and potentially come through the West Coast, how much does that add to time and shipping costs? Do you have any gauge on that?
Yeah, a couple pieces here. Right now, with the diversions that are taking place on traditional Suez routes, and I go back to my days working in the Middle East when we had Somali interests going after vessels, tankers, and container ships, and working very closely with NATO and other allied forces to protect our crews, cargo, and assets. This really gums up the works in the supply chain. And as you said, about 30% of container trade is moving through the Suez. 2/3 to 70% is going to Europe. Europe's lifeline to Asia is through the Suez Canal. Those alternate routes going around the Horn of Africa add another 14 plus, maybe even 21 days to transit times. And some accounts have said more than $1 million to the vessel voyages. Now, all of that aside, routing cargo from Bombay or Mumbai over Singapore and up to Los Angeles is going to be a quicker route and probably more cost effective at this juncture than the spot rates that are increasing through these hotspots.
And Gene, even before what's been happening with the Red Sea, also looking at drought, looking at the effect of climate change, also making some, and we have these very large container ships trying to come through. As you prepare for the future, though, how much are you investing with an eye on what's happening with climate change and some of these routes like the Panama Canal being affected?
Yeah, a couple of pieces here. As you know, Rochelle, we've got generational support at the federal and state level from an infrastructure investment standpoint. The Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and California Governor Gavin Newsom's own budget, which dedicated a tremendous amount of money to our ports and surrounding infrastructure. Those projects continue unabated and will move forward. And these are expanding our rail, roadway connectors, and grade separations, the ability to move cargo in and out faster, and taking some of the lessons we learned during the surge in COVID. On the green side of our business, as you're aware, by 2030, we want to be a zero-emission operating port with respect to the cargo handling equipment. And by 2035, all the 20,000 trucks here in the Southern California ports need to be zero emission as well. So that investment continues. I'll be in Washington next week with others campaigning for even more dollars coming to our green technology, as well as the necessary infrastructure on electricity and hydrogen that will go along with it.
Gene, we're a few years removed from that big backlog that we saw at the Port of LA during the height of COVID. Remember those ships just waiting offshore. Since then, we've heard so many companies talking about diversifying their supply chains. Nearshoring is the term that we've heard over and over, not really putting all your eggs in one basket. How much of that has affected the Port of LA directly? Are you starting to see that? And how do you prepare for something like that?
Kiko, while it's a conversation every day, the impacts here in Los Angeles have been minimal. We closed out calendar year 2022 with 57% of our business related directly to China. Last year, we closed out at 53% of our portfolio dedicated to China on imports and exports. But as I've said, with every conversation, whether it's with folks in Mexico, in Asia Pacific, even in South Asia, in India, more and more investment and more of a China plus one strategy from American companies and those who import and export. But you don't just pull apart supply chain relationships that have been in place for 45 years. Yet there is an eye on making sure that folks are not just sourcing from one location and get caught in a pinch with some unknown that will take place in the future.
Indeed, continuing to see some of that some of that future-proofing happening for companies. We do appreciate you joining us this morning. Hopefully we get some feedback from you when you're down in Washington. Gene Sirocco, Port of Los Angeles Executive Director. Thank you so much. All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Subway delivered its 12th consecutive quarter of positive sales and is seeing major success from a new menu announced earlier this year. And this comes after it was quite the year for the sandwich chain, getting bought out by Rourke Capital for $9.6 billion last summer. Yahoo Finance senior reporter Brooke De Palma has more on this story. Hey, Brooke.
Good morning, Rochelle. That's right. When we spoke to John Chidsey, Subway CEO, he really said that profitability for franchisees was something that he was very focused on. And we're starting to see some of the benefits from the major changes that he's introduced since he took the helm in November 2019. Now, the most recent change is something that happened just 2 weeks ago. They're calling it the Subway Sidekicks menu. And essentially, it's just sides that you can add to your order that they're really seeing strong growth in. That includes cookies, churros, and pretzels, leaning into that footlong business that certainly has resonated with customers. All these cookies, pretzels, and churros, all, well, a foot long. Since it was introduced just 2 weeks ago, they've sold more than 3.5 million side options. And we've heard from other fast food, fast casual chains that this concept of side options, food attached, as Starbucks likes to call it, really does bulk up ticket size. Now, in addition to that, other initiatives that have helped Subway includes that deli slicers that they've introduced at all U.S. locations. We also saw them introduce MVP awards, and sales continue to show strength. Globally, in 2023, same-store sales were up 6.4%. In North America and the U.S., same-store sales were up 5.9%, with the top 75% of locations up as much as 10.1%. Now, digital sales also a big business for them. John Chidsey, CEO, once again telling us at Yahoo Finance Invest that digital happens to be the most profitable channel in terms of the highest check. They also saw double-digit growth there as well last year.
Brooke, I had to look up Sidekick this morning for Subway, but a foot-long cookie.
Sounds
Did we
pretty
ask
good.
for that? A foot-long cookie.
It depends. Is it half-baked?
Looks pretty impressive. The company also doubling down on growth plans. What's the latest there?
Certainly, Akiko. That's been something that John Chidsey has also been very adamant about. For the first time since 2016, there was positive global net restaurant growth, and that really includes a new look of Subway to 18,000 restaurants. They remodeled 4,000 here in North America, and they also provided a new look to 12,000 restaurants. As you can see here, this new look and feel, they really try to get consumers back through the doors. And when we spoke to him, he said that he believes that global is a big opportunity for them. He thinks this is a sweet spot, the menu that Subway has. Compared to McDonald's and Burger King, he also said that he believes it takes a lot less labor. He said it's much less expensive to build than competitors, calling it very appealing to large restaurant developers. But you can't help but think of the competition here. Restaurant Brands International has that Firehouse Subs brands, also a sandwich chain. They announced recent incentives. You also have Jimmy John's, Jersey Mike, Panera Brands, among so many others, looking to get consumers in the door to grab a sandwich. And maybe a cookie.
Indeed. Not going to lie, that foot-long cookie, I think they might have sold me on that one. Appreciate you, our very own Brooke De Palma. Let's get you a quick market check. We're looking at green across the board as the market's really digesting some of those jitters from the Fed from yesterday. But that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Stay with us on Yahoo Finance.